Good morning, and thank you for tuning in to join us for today's roundtable for our post-implementation review related to the current expected credit loss model. I just want to start off with a thank you to all of our participants. We got some of them up very early, particularly on the West Coast, but I will tell you they've been active participants throughout our process, and I for one, am really looking forward to hearing their comments today as they share their perspectives. And since that's the most important thing that's happening today, let me turn it right over to Hilary Salo, our technical director, so we can get started.
Well, good morning, everyone, and just want to reiterate my thanks to having everyone here participating today. And as Rich mentioned, many of you have already provided feedback directly to the FASB through our post-implementation review process. And we really do continue to be thank you for the willingness of our stakeholders to engage in that process. So we're really looking forward to listening today, asking questions, and really getting a better understanding of your experiences related to the implementation of CECL. So this roundtable is part of a really important part of our post-implementation review process, and it does give the board and the staff the chance to hear feedback real time and then use that feedback to inform the research and analysis that the board uses to evaluate whether there is a need for standard setting actions to be taken on at this point. Today we are joined by all of the FASB members, as well as John Bonasdel, our SEC observer, Lisa Basudu from the PCAOB, and Robert Messer as our PCC observer. We're also joined today by the CECL project team from the FASB staff, who will be actively involved in the discussion today and have really been looking forward to today. Now, just in the interest of time, we are not planning to kind of go around the virtual room for introductions at this point, but I would ask that the first time that you provide your perspectives, please go ahead and introduce yourself and your organization as well. For those of you that are listening in, we have posted the agenda, the handout, and the participant list on our website so that you can follow along. And since we do have over 30 external participants, as well as FASB members, staff, and observers, and we're still in a virtual environment, at least for now, I do want to provide a couple of quick ground rules and reminders just to ensure that the conversation is as effective as possible. So we will be using the raise your hand feature. So if you'd like to provide your thoughts or observations on a particular issue, please go to the bottom of your Zoom window and click on the Reactions tab. And there you can click on the Raise Your Hand button. In addition, we will do our best to look for a physical hand raise or a touchdown indicator if you really want to respond to a comment that was just made. In addition, we would appreciate if everyone can keep their lines on mute until they're ready to speak. Now, we have quite a bit of material to get through today, so we are trying to stick with the timing in the agenda as closely as possible. First, we're going to discuss observations and feedback on CECL implementation overall, then followed up by a discussion related to purchased financial assets, so the accounting for PCD and non-PCD, and end with a discussion of troubled debt restructuring accounting guidance for entities that have adopted CECL. So with that, why don't we get started with topic one? So through our PIR outreach, we have heard some pretty consistent themes, some of which really did help to shape the agenda for the roundtable today. Now, this included feedback that entities were generally well prepared to implement CECL. However, there were challenges incorporating the quickly evolving macroeconomic environment into their models last year. We also heard support for the additional information disclosed under CECL, as well as suggested enhancements to disclosures to increase consistency and comparability. In addition, we've heard feedback related to the accounting for purchased assets and TDRs. Now, this certainly is not a complete list of the feedback that we've received, but really the point of the roundtable is to hear from you and to hear your observations on the implementation of CECL. Now, I understand that some of your feedback might be focused on items that we're going to talk about as part of topics 2 or 3. And while I absolutely appreciate that you may want to highlight those as part of your comments, we would appreciate if we could keep those in-depth discussions of those topics, if those could be held until we get to the next topics on the agenda. So first, would really love to start from hearing from our investors and our user participants. So we're really interested in what observations you've had when reviewing the financial statements and disclosures for entities that implemented CECL in 2020, including your thoughts on disclosures, whether you found the decision useful, if there are any suggested areas for improvement. So maybe I'll see if there are any volunteers off the bat. Maybe we'll go with Catherine. Thank you.
Thanks. Hi, good morning. My name is Cathie Wheeler, and I'm a bank analyst at KBW. And what I would say just generally is, I think one thing that was really good about CECL that I appreciated was just the flexibility that it gave the banks in increasing reserves in a very uncertain time. I think the CECL model being more forward-looking versus historical-looking, I think was a plus in such an uncertain time during the pandemic. So I think that for one was good. But I do think there were a lot of challenges on the investor side. I think if we think about how quickly we built reserves over the past year, that was great, but we're already very quickly seeing reserve releases. And so I think it'll be very interesting to watch over the next year how quickly we flip up and then we flip back down. And right now, the investor community, I would argue, is almost looking at the banks to return to a kind of where we were in a day one CECL. And there's an argument whether we get there at the end of 21 or we get there at the end of 22. But the fact that we can kind of increase so dramatically over 1 year and then get back to where we started only a year later, I think shows maybe a challenge and is the model truly effective. So that I think is one thing that we should keep an eye on this year. I think another thing that I noticed that I think was hard was the scenario weightings. So the disclosures around scenario weightings I found to be very helpful because that helped. It was hard to look at a bank and know, okay, are you increasing your reserves because you see more risk, or is it because of the inherent loan mix of your bank, or is it because you have a more adverse economic scenario more just generally? And so I think it was very hard, I think, for the investor community to compare banks to each other to see who was really who was driving a higher CECL reserve because of risk versus just conservatism. And so I think that was challenging. And so one place that we looked to try to decipher that was the scenario weightings. And what was so interesting is we found so much change in scenario weightings, even quarter to quarter. And so while I liked that gave the banks flexibility, we had some banks early on who didn't want to increase reserves too much because they were trying to conserve capital, had less scenario weightings to the adverse, or less weighting to the adverse scenario. And then we saw as we entered 2022, when the environment was actually starting to look better, we saw some banks shift to more weighting to the adverse because they didn't want to release. And so it felt like this arbitrary playing with the scenario weightings just to kind of get you to a reserve that you really ultimately just want. And I think that from the investor community was frustrating because it doesn't really indicate truly where the risk, the real credit risk lies. And then I do have comments on PCD, but Hillary, I think you want me to wait on that. That'd
be great, unless there's just an overall observation that you want to share. Otherwise, we'll have time.
Yeah, so just overall, I think one thing on M&A that was challenging for investors was just the PCD. I think the separation of PCD versus non-PCD it overstates the initial tangible book value dilution in a deal, and it overstates the initial accretable yield in a deal. And I think we would love to see acquired loans effectively treated the same way as originated loans, and not this bifurcation between non-PCD and PCD and this double mark that I think a lot of investors kind of found to be an overstatement of the discount on the reserve. I would also say in terms of the quantification of the non-PCD, that was all over the board. And so we had some banks that just, if there was any sign of credit weakness, they would assign the acquired loan as PCD. And so during the pandemic, we had some acquisitions that had, over 40% of the acquired portfolio was designated as PCD, but are these really at-risk credits? And you had others who, were taking a different approach, and you maybe only had 10%. And so I don't feel like the definition of PCD versus non-PCD was consistent. And so in that respect, it brought a lot of confusion to investors, and it felt like banks were playing games on how big they wanted their double count to be or not. And that's how they decided how they defined PCD versus non-PCD. So that would just be my big picture question or comment there, but we can go back to that when we get to that topic.
Okay, thank you, Catherine. And I see a hand up from Hal. Hal, do you have a question on Catherine's overall observations?
Yeah, just one quick question, Catherine. One area you didn't touch on were the various monetary and fiscal policy initiatives and actions that were taken. How did that factor into the changing risk environment?
It was really hard to see how it was baked into CECL forecasts. We had many banks, and they would put this in their disclosures, that would build up reserves, and they would say, this does not include any assumption around the stimulus. And then and that was very early on, that was maybe early 2020. And then as we kind of got through 2020, then you started to see some disclosures improve and say that they were including the impact of stimulus, but specifically how that was driving the numbers was very unclear.
And just to follow up, when you talk to investors by themselves, how were they factoring in, and I'm just going to say, generally speaking, the trillions of dollars that was let into the system over the course of the last year or so? How did they incorporate that into their thought process?
I mean, I think as you think about the amount of stimulus that we saw, the general consensus was that this is going to be a backstop for losses. And so generally, losses would be lower because of the amount of stimulus we saw. And certainly that's what we're seeing play out so far. And so I think early on, there was a lot of uncertainty. And so I think the reserve builds generally made sense. But as we started to see the government stimulus come in, it felt like some of the reserve builds we saw were really too high. But I would say the investor community didn't feel strongly, and this is a general topic I would love to hear from the other analysts, but I believe that the investor community didn't feel strongly that the reserve builds perhaps were too high. I would say really until we got to the back half of the fall, or maybe even early this year, as the vaccination distribution started to play out and we really started to see not a lot of credit issues. So the uncertainty, I think, was what drove a lot of the variability. But now as we're looking back, I think the stimulus is going to have a very big impact to drive very low credit losses across the industry. And that's what's going to drive the large reserve releases.
Thanks, Catherine.
Thank you. Joe.
First of all, good morning, and thank you for giving us the opportunity to share our thoughts. My name is Joe Stephen. I'm CEO of Stephen Capital Advisors, a private investment manager that focuses on financial institutions. I also am probably the senior citizen on this panel, so I've got my ARP card in the other room. But my background, I've been on three corners of the street. I was a Federal Reserve examiner, Federal Reserve Bank of St. Louis, early in my career, then at Stifel Nicolaus for over 20 years and 16 at my own firm. So, in addition, I was on the FASB's Investors Technical Advisory Committee for 4 years, including almost 2 years as co-chair. So some of my comments have already been made. I would agree with some of Catherine's comments. I think the fact that CECL did allow banks to build reserves faster up front ended up being a positive. Okay. However, in that same vein, we are now seeing banks having to reduce the reserves so quickly, literally 6 to 9 months after they built these reserves. And I guess I'm questioning that, is that really good information to be coming through the income statement for investors? And I guess I look at the concept, when I look at the FASB's own guiding principles, rules of procedure, we want information to fairly reflect economic reality. And if you look at a bank's balance sheet, approximately general terms, approximately 65% are loans, 20% are investment securities. Well, when there are changes in the investment securities by a fair value, that comes through OCI, and that's an accounting principle. And the same way with these rapid changes in CECL, which are really confusing investors, because banks have these big provisions, and so banks were criticized in the first 2 quarters last year people were saying, oh my gosh, these problems are coming. And you have to build these reserves. And now they're releasing them already. And you talk to the banks, and the banks say, our hands are tied. We're just following the model. And I guess my question is, as we look at this going backwards, I don't know if we want all that volatility just flowing through the income statement, because again, these are just guesstimates. These are guesses. And you're using outside people for these guesses. And we as investors, and you can chat with the other investors, but right now we continue to focus on actual net charge-offs, actual non-performings, and then whether the increases and decreases of reserves, we try to look through the notes, but we sort of back that out of net income because it really is quite complicated. So I think without me getting into a lot of other factors, I'll stop there because a lot of my other opinions have sort of been published, but I'll give you that thought.
Joe, thank you for that. Any specific views with regards to the disclosures that were provided through CECL?
I think that disclosures in general have been quite healthy, very healthy. And in fact, you could wear your eyeglasses out going through the disclosures. Is there comparability? Well, it seems the more you want higher levels of disclosures and more specifics on individual views, it allows comparability, but it also causes some confusion because there's not an exact standard. So it's quite complicating.
Thank you for that. Maybe, Hal, before we come back to you, I just want to be able to give a chance maybe for Saul to provide his comments.
Hi, I'm Saul Martinez. I'm an equity research analyst at UBS. I cover the large cap banks. So I know this is not an investor forum, but I will nonetheless read a disclaimer statement before I give my views. As a research analyst, I'm required to provide certain disclosures relating to the nature of my own relationship and that of UBS with any company in which I express a view on this call today. These disclosures are available at www.ubs.com/disclosures. Alternatively, please reach out to me and I can provide them to you after the call. So with that, I'll highlight a couple things and maybe, elaborate on some of the things that Joe and Catherine said. I'll probably agree with them on a number of things. But first on the disclosures, I agree that CECL has allowed for more useful information. It's helpful to us in assessing credit quality and assessing reserve adequacy. The allowance levels by lending category, whether it's C&I, CRE cards, whatever, is helpful in gauging where reserves are being built, where they're being released, helping with comparability when lending may be different amongst banks and whatnot. And I also think the information that the banks provide on macroeconomic assumptions, methodological choices around reasonable supportable period, mean reversion, probability weightings can give you a good and helpful sense of how they're thinking about the economic backdrop and the credit outlooks of their and relative conservatism that they're building in. But having said all that, there is some frustration here in that the disclosures are uneven and in some cases limited in many respects. And I'm not going to go into all of the issues, but they generally revolve around limited standardization about macroeconomic assumptions, both in terms of what economic variables are used and how they're presented. The sensitivity analyses some banks provide, others don't. In fact, I think in the latest disclosure, you're seeing fewer banks provide sensitivity analyses than in earlier disclosures. I think Catherine mentioned this. We have limited understanding of probability weightings, of qualitative overlays, and in my view, importantly, we have very little information on weighted average remaining maturities, which as you know, is critical in determining reserve levels. I think the second issue, though, I'll talk about is, kind of dovetails with what Joe talked about, and that is assessing core profitability under CECL and to what extent we do need to make adjustments to reported loan loss provisions. And it's a topic I feel like we discussed a lot even prior to CECL's adoption, given the potential for more volatility in provisioning in any given period. And it's obviously more important now with the pandemic and the big reserve true ups in the first 9 months of last year and more recently the reserve releases. And I think in our research we've indicated for some time now that that there's a very high likelihood, really, I guess we first argued this in late August and September, that reserve recaptures were going to be likely, and that has been playing out. And going forward, even if you don't think banks are materially over reserved, provisions are likely going to lag net charge-offs, and that's what we have in our models. It's what has been consensus numbers for 21 and 22. So you have a dynamic where reserves, could be falling while net charge-offs are rising from historically low levels. So, we argued in recent research that you do need to make adjustments, and if we want to think about what core profitability is and core earnings are, and using those basis evaluations, you need to look at net charge-offs, not loan loss provisions. And on these adjusted estimates, that's how we think banks should be valued. So I think there are various ways to skin the cat here on assessing core profitability, and maybe you take it to PPNR minus some through the cycle losses or something like that. But I think the broader point really is that adjustments are likely going to be needed, and non-GAAP adjustments will be needed if you really want to get a sense for core earnings and profitability. And I think so I'll flag that. We can talk about PCD versus or talk about acquisition accounting, and I'll give you my views later there, but they're very similar, I think, to what Catherine said. Not really too much to add right now, but I'll stop there and take any questions, I guess.
Okay, great. Thank you. And maybe Louis, would you like to provide your perspectives?
Yeah, sure. So my name is Louis Lau. I'm a senior financials analyst at Brandis Investment Partners. And we're a global investment firm with a long-term investment horizon of typically 3 to 5 years. I'd like to provide a little bit of a different perspective because I not only cover banks in the US, primarily the large cap regional banks, but I also cover a lot of European banks as well as emerging market banks. And right off the bat, I can tell you that I appreciate the disclosures from the US banks because it's at a level of detail that you don't get from banks in other countries. For example, with CECL, the publishing of loan to value ranges for mortgages, for first lien, junior liens, going down to the FICO score ranges, going down to the credit quality in the commercial loan book. These are disclosures that we don't get at other banks that are published. We have to ask the non-US banks for verbal indicators of what these might be. So right off the bat, in a global context, the US banks have the best disclosure. So that's what I appreciate about CECL. I went back to some of the regional bank 10Ks from 5 and 10 years ago, and that credit quality disclosures were not there before. So this is an improvement. On the relationship between the economic scenarios and the loss ratios, what we do is we actually go back and compare what happened to these banks in the previous cycles. So the most recent would be the subprime crisis from 2008 to 2011. There was a 4-year period where charge-offs and provisioning was elevated. And so we actually look at not just the bank's CECL projections, but we also look at the Fed stress tests. And primarily there's a DFAST 2020 severe scenario, but there's also the Fed COVID-19 scenario, right, which leads to 2 different adverse scenarios. And rather than rely on these scenarios, we actually make our own scenarios. And not to promote a particular trading strategy, but when we see share prices imply the higher end of these loss rates, that's typically a good signal to add. And if you see share prices implying a lower loss ratio, that may be a time to be cautious, right? So, and we don't pay as much attention to the quarterly fluctuations or even the annual fluctuations, because what we're more focused on is the bank's management, the credit quality, the long run credit quality of the bank. And we have a normalized rate of losses for this particular bank that we bake into the income statement to get a longer term view. So a lot of these fluctuations are noise that creates trading opportunities. So I think it's useful to understand the methodology and how they arrive at that. But I think we need to focus on the big picture and what we're trying to do for our clients, which is what share prices imply and what opportunities are created sometimes by some of the accounting and the economic assumptions and where we are in the cycle. With regards to loan modifications and TDRs, there was a question earlier. I'm not going to get into detail, but I just want to put in context the proportionality, because when you look at the CARES Act, the loan modifications, especially on the consumer book, that has created a lot of the proportion of the loan book that has been modified. And that is often more important than the TDRs, which are less than 1% of gross loans, right? So when we look at a situation like COVID, which we expect to be a very short is not the right word because it's been longer than expected, but that downturn we think is going to be a little bit less in magnitude than, for example, created by the subprime crisis, right? So we always look at past crises as a reference point and then make up our minds as to what we think is the most likely scenario. So I'll stop there and happy to take any follow-up questions and comment more later on. Thank you.
Great, thank you. And Hal, looks like you have a question.
Yeah, Joe, I'm going to go back to Joe's comment very quickly, and a yes or no response, Joe, is fine. You said that accounting should reflect the economic reality. Did economic reality change as a result of the stimulus packages, the relief packages that were developed and distributed, and as well as the vaccination development and its distribution? Did economic reality change as a result of those rapid responses? Yes or no?
Hal, obviously, information that comes out on a daily basis always changes the quote unquote outlook. Yeah, so that's, I would say, information that comes out today will change the outlook. But again, they're just trying, they're very, very complex. And obviously, as you know, CECL is a very complex model. It's based upon a tremendous number of assumptions. And unfortunately, as we've seen already, a lot of these assumptions have proven, and I won't say they were proven incorrect, but I'll take the words out of some other very bright CEOs. A lot of these assumptions that were used in the March-April assumptions have proven incorrect already. So it's a tough process, Hal. I don't know the exact answer.
Thank you. And Fred, it looks like you have a question.
Yeah, thanks, Hillary. I had a follow-up to Louis. Louis talked about the global bank comparisons and the disclosures were better in the US. Louis, do you have any overall concept, though, when you step back and look at IFSR 9 vis-a-vis CECL, any overall concepts of how you think about those two standards, not necessarily on disclosure, but just on the level of reserving that occurred under both? Thanks.
Yes, I think CECL had a faster reaction, and we saw reserve built much more quickly and much more responsively. And even IFRS implementation can be influenced by particular not accounting regimes, but country regulators. And so, for example, for the French banks, they have a universal banking model, so they're a little bit slower to build reserves. So we didn't see that go up faster. And they and the UK banks are both implementing IFRS 9. The UK banks built reserves much faster because of the influence from the Bank of England and the FSA. So even within IFRS 9, there are differences in the speed of response depending on the influence of the country regulator. So accounting standards are one thing, but you also have to look at the culture of reserving in each particular country. And so there can be differences in IFRS 9 within different European countries as well. But I would say in general, CECL has been more responsive. Although I would say some of the IFRS 9 disclosures have been more granular coming from the European banks, particularly the UK banks. I won't go into detail here, but I think the US banks do a fine job, but I've seen some IFRS 9 banks provide really rigorous disclosures as well.
Great, thank you. And, I think it might be a good time to switch and get the preparer perspective. So Victor, or I see your hand up. Would you like to give your thoughts?
Thank you, Hillary. I actually had a question, going back to Joseph's comments earlier. Joseph, you said that, you perceived that investor focus on charge-offs as being, a key metric. But, obviously that's reflecting what's already happened, what's happened over the last quarter. Do you also feel that there's, an investor focus on any level of, preparer projection? And obviously I'm thinking about, sort of the old incurred loss model where, you at least got some sense of what management was thinking, 12 to 15 months out.
So let me try to capsulize your question. I mean, under the old incurred loss model, which is sort of a little misleading, banks, and if you look at the statistics that KBW or somebody could provide, banks typically were reserved out for 24 months of charge-offs. And that's sort of how the math worked out for the last 30 years. I would again go back to, I think CECL does provide the ability for banks to build reserves faster, which, and then the management teams are allowed to give their reasons for that. But I guess, Victor, where do you want me to go from that comment? I guess I'm confused with what you want me to try to answer.
Just whether, in your view, investors, have an interest in the preparer's projections of, future credit events, because that's what CECL does. That's what the old incurred loss model did. And, a focus on charge-offs doesn't really provide that.
And again, I was trying to keep my comments brief. We absolutely are very interested in the outlook for management teams. However, in CECL, it's not only your outlook, it's the outlook on third parties that when you ask these banks, people say, well, what's your provision going to be this quarter? Let's say your charge-offs are going to be a certain level. We've had a number of banks, some who are participants on this call, they have already given their estimate for charge-offs this quarter. But you ask them what their provision's going to be, and their response is, I have no clue until June 30th, and I get the inputs from the third parties. So that's the volatility I'm talking about. Many of these banks have already indicated what they think their outlook for charge-offs are going to be, not only for the second quarter, but for the whole year. But you ask them about their provisions, and they have a very difficult time giving any type of guidance. And that's really my one point. I think it really makes the quote unquote release of earnings very confusing. I'll use some adjectives: confusing, misleading. I don't know what exact terms. So you have to make a number of adjustments to try to get what you think is repeatable, sustainable, core operating profits.
Thank you, Joe.
Thank you.
Victor, did you have any overall observations you wanted to share with the group before we talk to others?
Sure. I mean, we joined Hillary with the comments that you made earlier. I mean, in terms of being able to implement CECL in a very challenging sort of first quarter. We were able to do it. We had good time to prepare. We had not really suffered any adverse operational or disclosure impacts as a result of adopting CECL. We have some thoughts with respect to PCD and acquisitions, which I'll come back in and talk about. But overall, I think, I think we've been happy to implement it.
Okay, great. Thank you. Brad, that you had your hand raised.
Yeah, thanks, Hillary. And, I'd just say thanks to you and Rich and others who have reached out over the course of the last year. I've enjoyed our couple of conversations that we've had on some of these issues. I want to go back to what Joe and Saul both referred to there as, information on the income statement, because, as we sit here today, and I'm the controller and chief accounting officer at Regions, that's our biggest concern is, these reserves that we all built in the first and second quarter of last year in good faith with the information we had at the time. But as life has played out to where we are today, it just doesn't look like those losses are going to manifest. And so as has been discussed, we've started to see reserve reductions as early as the fourth quarter and broadly across the industry in the first quarter. And to the extent that in so many cases, you now have credit provisions that are being booked in most of the industry. And the quality of earnings for booking a credit provision just does not seem to be appropriate. And, while most of us on this call can all look through that information, we have disclosures and can see charge-offs, make adjustments as has been indicated to be required or necessary for investors by Joe and Saul. An average investor who has bought stock in a company, it looks at net income and looks at earnings per share. And if they're not getting the true reflection of what's going on in a company, then that's not really good quality. And that's not good decision, useful information. So, as has been discussed by these investment analysts, I think there could be a framework that could be considered that would have a short-term portion of the true up to the CECL reserve to go through the income statement and a longer term portion go through capital. We all want to make sure we've got enough capital to absorb the losses. But this income statement, and yes, it's volatility, but it's also just something that doesn't seem to be accurate in terms of the reporting period. For instance, a lot of the banks on the panel here today make adjustments to our incentive plans. You can see those in proxy statements to take net revenues and use charge-offs as a reduction against that. So, our compensation committees are making those same adjustments that these investment analysts are making. It really wouldn't be very difficult to have a short-term framework that would use something. Charge-offs, for instance, could be something that could be used. And, we think that would be a good revision to the standard, is something that ought to be considered.
Thank you, Brad.
Thank
Jay.
you.
Hillary, thank you. First, thank you so much for the opportunity to participate. I'm Jay Cochran. I'm the Director of Accounting Policy for Truist. We really applaud the FASB's effort in post-implementation review, both to review the opportunities that we've had to share insight and to respond to questions, particularly around PCD and TDR accounting, which I know we'll talk about later in the panel. We would just agree with the comments that Brad has shared, that in addition to those key areas of post-implementation review, that we do think it would behoove all of us really to, further consider whether further consider whether kind of the significant earnings volatility, not in and of itself necessarily, but just the extent to which that was reflective of the quality of earnings in the underlying financial institutions, and really to the extent that that was useful or and or confusing, to the analyst and investor community, and some of those thoughts have been shared today. So we would, it's really like we have a case study in the potential impacts of extreme uncertainty from a forecast perspective can have on the income statement in particular. And so we would strongly recommend, and we would be very willing to participate, in any further outreach around just considering the impact that CECL had during this extremely difficult time of high pandemic related uncertainty, but the impact that CECL had particularly on the income statement and the meaningfulness of that to the investor community. And even when we look at just a group of 10 of our peers and ourselves, the reserve build, the excess of provision over charge-offs, primarily over the first half of the year was in the tens of billions, and just through the first quarter of this year, nearly half of that has reversed. And so all of that happening in a very short period of time, we're really just a high degree of uncertainty was, the defining characteristic that we all have lived through in many respects. And so that, we would, I think, echo Brad's thoughts that it would behoove us to give consideration to, any lessons that we've learned from the extent of, the impact to quality of earnings that we've seen over the past year. Thank you.
Thank you so much. Jason.
Hi, it's Jason Weipert from Capital One Accounting Policy. First of all, I echo both Brad and Jay's comments, so I'm not going to repeat those, but do want to highlight that the income volatility was a concern for us through CECL. I think the other thing I'd make, we appreciated the flexibility that the CECL model gave us in estimating losses in a period of uncertainty, and having our framework choices of how we're going to model losses and being able to accommodate those based on the information that was coming was helpful. The flip side of that coin is that, as the investors mentioned, the disclosures are uneven because people are making choices differently. And, not everybody weighs economic scenarios as part of their core numbers. And so that information may be useful for one bank's reserves and not useful for another's. And so all of that stuff in a period like we went through last year, I can appreciate the frustration that could be to try to understand, because you don't have a period of normalcy to try to understand how a bank does things. So we really did appreciate the flexibility and took advantage of it each quarter. But yeah, how to communicate that message and how to have it be comparable when we look at our peer disclosures as well is definitely a challenge. And it's not one we have a ready answer for either, because again, each bank can make their own choices on how they get to that best estimate of loss. And so that makes it hard to compare from one to the next.
Great. Thank you, Jason. John.
Oh, yes, thank you. My name is John Taylor. I'm head of our accounting policy group at M&T Bank. And I'll share some of the sentiment that was just recently provided. I think Jason said it best is I think what was good about CECL is it did give you some flexibility to react to this very uncertain time. Of course, as he indicated, that causes some comparability issues. I think by its very nature, the whole process has to be judgmental. Despite the fact that particularly larger institutions, most banks went into a highly complex quantitative modeling approach. You needed that flexibility as the models were stressed very early on in the process. And frankly, oftentimes just intuitive results, particularly in the government stimulus and that. So I guess it's just helpful to remind you and investors that it is it requires a lot of judgment on the back end, regardless of what the model results are spitting out. Overall, I think it was a very challenging time. It stressed a very immature process. So, but I think I think the banks did a relatively good job doing that. I do think some of the earnings volatility. I do think maybe we as an industry should take another look at that. I think that is impacting the quality of what's being reported.
Thank you very much. And Mark.
Hi, thank you. And this is Mark Sidlinger from Ally, and echo everyone else's thanks for bringing us together today to have this conversation. Just, I guess, piling on to both Jason and John's, current comments about the need for judgment and flexibility. Just really want to emphasize the fact that every bank's portfolio is different. The data banks have available to them is different. And all of those things are absolutely paramount to the bank coming up with their best estimate. So we think those parts of CECL are necessary and required. I think going into the CECL implementation, one of our concerns was that maybe there over time would be some narrowing of, well, you have to do it this way or you have to do it that way. And I'm not sure that would be in the best interest of getting to the right numbers in terms of how we estimate our CECL reserves because of the differences at each bank with each portfolio and with the data that's available. So just wanted to add that point and that emphasis. Thank you.
Thank you. And Doug, you have your hand up, and you're certainly interested in your perspective because your entity hasn't yet adopted CECL. Is that correct?
That's correct. This is Doug Wright. I'm a CFO for Mission Federal Credit Union, and we have not adopted yet. But I think, what I think is interesting is the unique interplay between CECL and the pandemic. And I think one thing it points out, and one thing we've heard from both the users and the preparers, is that everyone appreciated, quote unquote, the flexibility that CECL provided to be able to increase reserves. What's interesting about that is that the non-filers basically had that flexibility as well, or the people who haven't adopted yet had that flexibility as well. Because I think if you look at the industry, the community bank and the credit union industry, we increased our reserves substantially as well using the incurred loss model and the Q&E factors. We boosted the Q&E factor, and because there was so much uncertainty and kind of lack of good information, we had basically the flexibility. And I think the accounting community essentially allowed the flexibility to boost the Q&E reserve substantially. So I don't have a comparative about, how much we boosted our reserves, the non-filer community boosted their reserves versus the CECL community. But I think in general, the industry substantially boosted reserves during that period of time. So one of the things I think that's interesting that you play out in that is that if that flexibility is there, regardless of which model you use, whether it's incurred or CECL, if you have that flexibility, it accomplishes what I think the industry wants to accomplish, is the ability to increase reserves if you have that kind of forecast or that kind of sudden event that requires the increase of reserves. Where I get back to the challenge, I think, for both institutions who have already filed as well as institutions who are preparing to adopt CECL in the future, is this whole concept of life of loan. And that adds a lot of additional complexity that I think the non-adopters at this point are really wrestling with, is how do we adapt to not only being able to forecast and have the flexibility to increase reserves if we definitely see an event like a pandemic or recession or whatever coming, but how do we also extend that over the various lives of loans, of all the different loans that we have? And is there a way that we can accomplish what I think what the industry is really wanting to accomplish, which is better forecasting, and you can argue whether you have better forecasting given the build of reserves and the sudden drop of reserves and the assumptions behind that, without the complexity of having to look out over, a long life, asset.
Thank you, Doug. Don?
Hi, everyone. Thank you for letting me participate. Donna Dechevits from Ford Credit and Ford Motor Company. So, I agree with a lot of the comments that are coming across from all the participants. And as I sort of think back to when we first stepped into CECL and getting ready for that, we had a third-party system that we purchased to be able to calculate the reserve. We buy third-party economic data to feed into that reserve. We did a lot of data cleansing from our source systems, even though we only have a couple. We do have a lot of different country variations of data within those systems. So we did a lot of work to get ready, and then stepping in, COVID hit, and we overlaid a lot of it with the management judgment because of the fact that that historical data didn't contemplate anything like we saw at that time, right? And that's what everybody experienced, and everyone took up reserves. Fast forward a year, we're still struggling with that because now we have this phenomenon of the losses coming in at very low levels, even though unemployment, for instance, one of our key economic factors, is very high, right? And so we struggle still with trying to figure out how much to make that adjustment for, and how much has the federal stimulus offerings impacted the loss rates, and how many losses are not completely foregone but just deferred and eventually could come to fruition. So those are the things that we certainly are struggling with. And I don't know if that's necessarily just a CECL model. That's just an overall loss reserving, issue probably that we would have with the old incurred model as well. Other practical things that we deal with as well, though, are also the fact that we do have IFRS locations. So we go through the process of recognizing entries on a US GAAP basis, and then we release and remove all of those effects and get to an IFRS basis for some of our locations. So there are some practical challenges that we do deal with by having two different sort of horizons with the lifetime versus 12-month view as well.
Thank you very much. And just in the interest of time, I think I'll go to Linda, and then we'll look to get some feedback from our practitioners and regulators that have joined us today. So Linda?
Yes, hi. Okay, so I'm going to be a little bit more positive because I think FASB did a really good job in giving the preparer community lots of flexibility. There was extensive outreach and there was a lot of responsiveness. For example, with available for sale securities, the FASB took industry input quite seriously and provided a substitute model to the CECL model, but one that's closer to what used to be the OTTI model. I think that one of the big issues we all had because of the pandemic was that no one contemplated a disaster of the proportion that CECL turned out to be. So our models were built looking to 2008 as what we thought was an extreme circumstance. So we all had to rerun our models, provide management adjustments to contemplate the additional severity of COVID. But overall, I think CECL has enabled us to learn a lot more about credit and credit losses. So I do think that CECL has been helpful in the long run. With response to the volatility that the analysts mentioned and some of the banks did as well, that's what CECL is designed to do. You build your model based upon what you see today, and as your outlook changes, then your reserve changes. And that's what happened. No one knew how long it would take to put a new vaccine into effect and whether or not those vaccines would work in bringing down the infection rates. No one knew how long the stimulus programs were going to continue. So there was lots of uncertainty, and the models reflect that. And I think they reflect that pretty widely across at least all the big banks, that people reacted in similar directions, maybe not with the exact same numbers. I agree with Mark Sidlinger's comments that all banks are different. Their models, therefore, are different. Their portfolios are different. We have, like Ford, we have IFRS followers in 69 countries around the world. So we are doing multiple variations of credit losses, but we were doing that anyway for CCAR versus CECL versus the LLR in previous periods. So that's just something that is part of being a global organization that people need to deal with. I do have some comments about TDRs and PCDs, which I'll save. But the one thing I do want to raise is that guarantees, I think, is a misfit for the CECL model. I don't think it makes any great sense. Those guarantees are already recorded at their fair value, and they are on the liability side of the balance sheet. So people don't really understand what that really represents. And then the distinction between performance guarantees and financial guarantees is another distinction that we think doesn't have a lot of merit. Our credit people think a performance guarantee is one step removed from credit risk. So we would, if you're going to have guarantees, it should be all guarantees. But we think the better answer is just to remove them from the scope of CECL. And I'll stop there.
Okay, thank you, Linda. And I know we have a couple of hands up from the preparer perspective, but I think we are going to just shift over to practitioners for a bit and see if we have time to come back to you. So we are very interested in understanding, from practitioners, their experience actually auditing entities who adopted CECL during 2020, as well as from a regulator perspective of, overseeing entities that adopted CECL. So certainly looking for perspectives from the group here. Maybe I will start with Chip.
Thanks, Hillary. Thinking about approaching auditing CECL, we started early, tweaking our, updating our audit methodologies, bringing in the credit specialists that we had internally to be able to leverage their experience in auditing. We went through many of the same challenges that I think you heard from the banks, right? We spent a long time looking at their models and their processes and their controls as they built them for adoption, and then things had to significantly change as they had to pivot to deal with the economic environment. But overall, our experiences, it went all right. Our banks, while their control frameworks had to morph and change, they held up. We think they overall did a pretty good job in pivoting and reacting, and we sort of followed along their process from an auditing perspective. So, but it definitely took a lot of preparation and planning. But overall, we thought our audits went pretty well.
Great, thank you, Chip. John.
Yeah, a lot of the same observations. I mean, for us, it wasn't necessarily the CECL adoption that was difficult. It was really the pandemic and the economic environment. And we would have probably had a lot of the same challenges even under an incurred loss model. I think for, one observation that we have is probably more for the people that haven't adopted yet. I think, especially a lot of the people that are in this meeting that have adopted, have a lot of their own more sophisticated entities, have a lot of their own internal models, and a lot less reliance on third parties for modeling and for the data. And I think, those were the challenges that we had going into it for those that did use third party modeling is, not only us getting comfortable with it, but, getting the organizations to understand that they need to, management needs to understand what's going into those models and what adjustments they need to make to those to be consistent with their own portfolio, right? Not just have it be more like market data. And I think for those that are going to be adopting later, our feed right now, or at least what we're seeing is there's probably an expectation that there's going to be more reliance on third party models with the smaller adopters. And so that process, which granted they have more time, but the pandemic certainly put a hold on them, maybe even getting their CECL preparation done. So we're having a lot of those conversations as far as telling them, this isn't something you can just wait and plug into a model. You're going to have to get comfortable with it. And so that's probably going to be a bigger challenge just for the later adopters and third party models.
Thank you, John. Graham.
Yeah, this is Graham Dyer with Grant Thornton. Echoing what John and Chip shared, I think John made an important point that, actually it's one that Mark raised during the preparer comments, is that one of the challenges we faced in auditing during this particular time period was that a lot of the assumptions that entities had between loss rates and the things that drive those loss rates broke. right? We saw disconnects between unemployment rates and charge-off rates, between GDP and all kinds of things that historically have been true. So I think that was a challenge, but that's not a unique CECL challenge. That's just the challenge of the economic environment in which we were auditing. And then to build on to John's kind of last point there, I think two challenges that we saw that were really acute in our client base. One was establishing the relevance and reliability of third-party data in their particular implementation scenario. So you're getting nationalized data, but you operate in a regional setting. Determining the relevance and reliability of that data was a real challenge, and I think will continue to be. In fact, may even be to some degree exacerbated in sort of the near future, because now a lot of that data will include this time period where we saw sort of breakdowns in historical relationships between economic indicators and losses. So I think that's just that's just a challenge of the current economic environment. And then I think the other thing, and John alluded to this as well, is, it's not just standing up a process to implement CECL, to build a model. It's standing up a process to maintain and continue to evaluate the appropriateness of that model on a go-forward basis. And so that's a challenge, but I mean, that's something I think I've been really quite impressed at the way even smaller and medium-sized entities have risen to that challenge and developed those processes. So I think it's actually been a success story in many ways.
Thank you, Graham. Sydney.
Hi, this is Sydney Garmon from Crow. Hey, just to maybe add a few more observations, I think what we saw in particular with the smaller adopters, especially under 10 billion, 150 or so, or even under 20 billion, they really struggled in terms of just resources because that group was very reliant on third parties. They really could have used, I think, a little bit more time, because I think what you saw during especially 2019 was a slippage in the SAB 74 disclosures, where we thought we were going to be ready in Q1 to disclose a number, and then it slipped and slipped and slipped. And so I think that it just took longer than what everybody expected. I think there could have been more of a benefit to more parallel runs, more refining of Q factors. And so as I thought about, well, why is that? I think it's because the banks under 10 billion, they were never subject to DFAST. And so I think the institutions that were subject to DFAST pivoted when they didn't have to do that anymore and allocated all those resources. Okay, you people know I'll go do CECL. And so I think that was an interesting outcome. So I do think the points about reliance on third parties and lack of resources is going to continue to be a challenge for the smaller institutions.
Thank you, Sydney. Stavros?
Thanks, Hillary. Stavros Afaridis from EY Professional Practice National Office. I think from our perspective, needless to say, a number of challenges in the 2020 adoption, just given the pandemic. But with that being said, leading into the January 2020 adoption, we did observe that, preparers in general were well prepared to implement the standard. There were not many questions being asked around the technical application of the standard. The model was well understood, and preparers clearly put in the time and work necessary from a model governance and process and controls perspective. So that's a testament to the standard setting process that the FASB undertook, soliciting feedback from all market participants. The TRG process was extremely helpful. And of course, giving preparers the time necessary to build out their frameworks was very beneficial. Needless to say, though, there were a number of challenges in the adoption, just given the effects of the pandemic. I would say, we observed that preparers were dealing with, obviously, what was a very dynamic environment. The speed at which economic forecasts were changing during the pandemic was quite unique, especially early on in the pandemic. Data and modeling in particular was a challenge for many institutions, and that's an important point that Graham made, because models by their very nature have inherent limitations, and those limitations are typically driven by data, right? So trying to model credit losses in an environment where there's a lack of comparable data is a challenge. But I do think preparers, for their part, as part of their implementation, did a really nice job in developing governance frameworks that allowed them to pivot and make the necessary adjustments within that framework. So not easy by any means, but we did see companies' processes evolve throughout 2020. And we also saw their disclosures evolve throughout 2020 in a meaningful way.
Thank you. Just in the interest of time, interested if there's any views from our regulator participants today. Laura?
I feel like Stavros was mouth because I agree with many of his opening remarks, and that I think everyone does need to take a step back. And I heard it several times here. Everyone recognizes what a challenging year 2020 was. It was a tough year of volatility and uncertainty, and given everything everyone had to deal with, I think everyone should feel good, particularly the preparers and the practitioners, about being able to successfully navigate all those challenges and implement CECL in such a tough year. I mean, for us, we're definitely in learning mode, and we're actively monitoring CECL implementation and the impact it has on financial institutions, including regulatory capital requirements. So we're closely monitoring and very much in a learning mode mindset for now.
Thank you. Jeff?
Thanks, Hillary. I'm Jeffrey Gear. I'm the Associate Chief Accountant at the Office of the Comptroller of the Currency. And so I'm here in that official role, as well as my unofficial role as the President of the Friends of CECL Society. So overall, we continue to believe that CECL is an improvement over the incurred method. We are seeing that CECL generally resulted in recognition of credit losses sooner, which actually surprised me a little bit because I feel like the loss event happened in the first quarter, but we still see that the incurred losses are lagging. And so really the new standard is doing exactly what it was designed to do. Allowance levels at our CECL banks approached the highest levels that we saw during the Great Recession. And they also reflected a sizable coverage of the DFAST stress losses over a nine quarter period. So fortunately, we were also very happy that CECL banks maintained relatively robust CET1 capital ratios despite those large allowance builds on day one and in the first half of 2020. And something that really highlights that, again, is that CECL has been effective, is that we do see earlier recognition. When we compare in all portfolios where we compared CECL to incurred bank portfolios, CECL was the greater coverage. And even with commercial loans where it actually went down at the beginning, and so it was actually under incurred early, is now in excess of incurred. And of course, credit cards is probably the most dramatic difference that we've observed.
Thank you, Jeff.
Thank you.
John?
Yeah, I would just like to echo my peer chief accountants. We spent a lot of time with a lot of you folks pre-CECL implementation, working through the process and the impact of the adjustments coming in and the preparation that took place. We're generally pleased with what took place there. So you can see that everyone was prepared for it. Now, I will tell you that there is some concerns, and we continue to message to the institutions that have not implemented CECL and are planning for 2023. Some of you guys took a little time, maybe into March of 2020, before you had all the documentation ready. So we do want to message that we think CECL was effective. It created a great buffer for what we went through with the pandemic. And overall, I think it is the right way to go. We just need to make sure that we don't overburden the smaller institutions as they prepare for CECL.
Thank you, John. And Jeff, did you have a comment that you wanted added? Okay.
Yeah, I forgot. I should have given kudos. I didn't want to give kudos to the CECL banks because we were actually quite impressed at how they implemented so far in the middle of a pandemic, likely remotely. So I wanted to mention that, and I also wanted to mention that I largely agree, with comments I think that came from John Howard and Graham Dyer, that the problem was the pandemic and the economic situation, not the accounting model. So I don't think it'd be fair to blame it on CECL.
Okay, thank you, Jeff. and appreciate that we could probably have the entire 3-hour roundtable to go through everyone's views on the overall adoption and implementation of CECL, but would like to shift gears and move on to topic 2, which is the accounting for purchased financial assets. So I'll ask Jay to just give a quick tee up to the group before we get into observations.
I just want to make sure everyone can hear me okay. Thumbs up. All right, great. So this is a little longer than a short one, but hopefully it'll go quick. So at the December 2nd meeting, the board instructed the staff to conduct an additional research and outreach on concerns related to PCD accounting that stakeholders brought up during the 2020 PIR outreach, including feedback from analysts who noted the recognition of a provision expense on non-PCD assets was unintuitive, and there was too much diversity in practice related to which acquired financial assets qualified for PCD accounting. So following that meeting, the staff conducted outreach with preparers and practitioners to identify views on addressing those concerns raised throughout PIR outreach. During this round of outreach, most financial statement preparers supported expanding the scope of PCD accounting to include all purchased loans and held-to-maturity debt securities. There were other views that were shared by preparers, including 1, expanding the scope of PCD accounting to all purchased and originated financial assets, expanding PCD accounting to all purchased financial assets, 3, expanding PCD accounting to all purchased financial assets with an element of seasoning, and lastly, expanding the scope of PCD accounting to apply to only purchased loans while removing all debt securities from the PCD framework. Practitioners noted that while they understood the PCD accounting framework, it was a bit too early to share feedback on their observations from specific transactions that occurred during 2020 due to a rather small sample size. Instead, practitioners provided high-level feedback to express their views on potentially modifying the scope of PCD accounting and noted the following. So one practitioner understood the desire to expand PCD accounting to non-PCD loans, but indicated that PCD accounting should not be applied to originations. Another practitioner stated that if the board were to open up the guidance to make a change to PCD accounting, that they should apply PCD to all financial assets in the scope of CECL, including originations. Another practitioner noted that they understood the merits of expanding PCD accounting to all purchased loans and debt securities, HTM debt securities, but were apprehensive to expand PCD accounting to those financial assets purchased at or above par. This practitioner suggested that an element of seasoning should be considered by the board if they were to expand PCD accounting. And lastly, one other practitioner noted that the PCD accounting should apply to all assets acquired in a business combination, but not an asset acquisition. So in today's handout, the staff provided examples to act as a refresher on the accounting for differences between PCD and non-PCD accounting, as well as an example that illustrates how expanding the PCD expansion would work with a hypothetical scenario if you were purchasing a pool of loans. And so effectively, example 3 just highlights how applying the gross up approach to a pool of loans purchased at par to show how the non-credit premium amount would be established and then amortized over the life of the loan as an adjustment to yield. One thing I just want to be clear on, because it did come up after we shared the handout, was that this example 3, it's not a new alternative or an approach. Rather, it's just the expansion of the PCD accounting model to a larger pool of assets, if you will. And then the last comment I'll make before I turn it over to the group, just on the examples themselves. Those examples that we put in the handout are just that. They're purely examples. They're not intended to highlight the board's views on what qualifies for PCD and non-PCD. They're hypothetical. There's always one person who calls and says, is this what you envision for us to apply the PCD guidance? The answer is no. We just put those examples in there for ease of conversation today. So with that, I'll turn it back over to the group.
There we go. Thanks, Jay. So maybe we could turn it to our investor group. And, we're certainly very interested from your perspectives. And I think we've already had a bit of a preview from Catherine and from Saul about, their views with regards to the current accounting model for purchased assets. And certainly we'd be really interested in thoughts on if the board did expand, the accounting for purchased assets or expanded PCD to the accounting for all purchased assets, how would that impact your analysis of entities and, net interest margin? So maybe I'll turn to Saul first. I know that you had a few thoughts you wanted to share on that.
Yeah, I mean, I guess I'll be, be fairly brief here, actually, because I don't know that I have a ton to add in terms of going into, the minutia of the accounting. I think the proposal is good in a couple respects. Obviously the treatment of non-PCD and the double hit to equity effectively when you take fair value mark or credit mark, I should say, and a loan loss reserve. Getting rid of that, I think, is a positive, and the simplification of definitions is important as well. I think Catherine mentioned the inconsistency in terms of the treatment among banks. I think where I still struggle a little bit here, though, with the proposal, maybe this is my somewhat uninformed view or something, but you still are commingling the NII impacts and the loan loss and the deferred recognition of the loan loss provision true up or you gross up the loan balances for the allowance, and so that still creates some fact that maybe is not optimal. And I think from our perspective, you do have that. I don't cover as many companies as say Catherine does, who's gone through M&A transactions. My focus is on the largest banks, so I do cover Truist and PNC and M&T. But for Truist, for example, how we're treating purchase accounting accretion and the impact of that and how that will evolve and whether we should adjust for that in terms of the earnings, those are all sort of relevant questions. So the dynamic where we are, my understanding of the example is correct, where we are effectively deferring that allowance and offset negative impact NII is a little bit problematic. Maybe in practice it's not going to be a big deal, but that's what I would say. I mean, it does seem to be an improvement from a definitional standpoint, and certainly getting rid of the double hit equity is something that seems to be a pretty relevant positive. But that's pretty much what I would say about it.
Okay, thank you. And maybe Catherine, I'll give you an opportunity to provide a few more thoughts.
Yes, and I would agree with just a lot of what I like about this new proposal is that I like that we're going to look at all acquired loans as PCD. I think that takes away the double count. I think that provided we talked a lot about the volatility in the income statement. So on day one of a merger close, we have that large provision bill to provide for day two. So that would get rid of that. So I think that's a net positive. But I agree with Saul in that think about just the way we look at originated loans. Whenever there is the credit changes with originated loans comes to the provision, and net interest income, the yield impact comes through the margin. And so I think from an investor perspective, just very simply, I think it makes sense to keep credit changes in the provision and in the reserve and interest rate marks and changes in the margin. And one thing that we've liked about CECL was it took away the volatility of accretable yield. But I do worry that if you still incorporate some kind of a credit mark in this discount, you're still going to have some credit component within the yield accretion that still may drive volatility and confusion for investors. So if there is a way to kind of look at this more simply where we are just day one, we have all acquired loans are PCD, acquired loans are going to treat it as PCD loans. They get a reserve that goes in as equity, doesn't come through income statement, just goes through kind of a mark on day one. And then any kind of interest rate marks are in the discount, and that's what kind of flows in through what we call accretable yield. I think from the investor community, that makes more sense because it is more reflective of how we think about the originated loan pools as well.
Okay, great. Louis or Joe?
I can chime in first. I think the first time I struggled with this was in 2008 with the acquisition of National City by PNC Bank. And back in those days, the difference between the core NIM, net interest margin, and the reported net interest margin, I think became quite apparent because it was distorted by the effects of large acquisitions. So I care less about the securities being subject to PCD, but really I would like to see large acquisitions, particularly if material size, for example, the SunTrust and the BB&T merger resulting in Truist. I mean, that's very material. And to this day, there is a 30 to 50 basis point difference in the NIM caused by purchase accounting accretion. So I would like to have the loan marks also identified by duration. So the loan mark, the credit mark, how long is that going to reverse? Because I'm going to do a present value analysis of when that is going to be accreted to, the bank value, and then have that net interest margin be free of any credit reversals. Because I'm also performing interest rate sensitivity in a rising rate environment on the net interest margin. So I want that to reflect basically how the yield would move and not really the reversal of credit. So I agree with Catherine that we need to do a better job separating the interest rate effects with the credit effects. And I'll stop there.
Thank you. Joe?
In the interest of time, I won't reiterate thoughts. Number one, getting rid of the non-PCD, I think, is good because it eliminates just another form of accounting for loans. So then we'll be down to two, originated and then PCD. And most of the comments from the three previous panelists, most of the comments I agree with. I do think the 800-pound gorilla in the room, though, is the fact that that acquisition accounting absolutely needs to be looked at, because what is happening with the current acquisition accounting, it's putting many entries on the balance sheet that then either become amortized or accreted, which investors end up backing out because of the complexity. So, and I've talked to Rich about this. I mean, I think the acquisition accounting model, that the simplest one is that, and then I was a regulator 38 years ago, goodwill was considered valueless. However, banks are required to put all this goodwill on their balance sheet in an acquisition, a typical acquisition. And now I hear the FASB is looking at, do we amortize, non-amortize? Again, these are, you're rearranging deck chairs that don't matter. So I would just say, I agree getting rid of non-PCD, but I think it also brings up a point you have, at some point in time, simple combination accounting has to be explored.
Thank you, Joe. So with that, be interested in getting perspectives from others within the group here. So maybe we'll start with Lee.
Good morning, it's Lee Campbell. I'm a vice president of the technical accounting group at MetLife. I'm also representing the ACLI along with Caleb from Athene. So I think our views are in a large part aligned, and so I'll try to be as succinct as possible, and thanks for including us in this ever-changing accounting landscape, so I appreciate the time. Overall, from a PCD perspective, I don't think, we struggle fundamentally with the concept of PCD, not only because of the cost and complexity and some of the inconsistencies in the different models of the different instruments, which in a large part can't be helped. Conceptually, we struggle because essentially we're showing on our balance sheet as a purchaser credit losses that are never going to be incurred by us as a purchaser. And so starting with that point, there's a little bit of a struggle just conceptually, although we were able to implement the standard, and there were some issues in implementation regarding PCD related to debt securities in an unrealized gain position, where the FASB offered relief. On top of that, I think this model seems to go a little bit further, and I think Catherine was alluding to it, whereby you're forecasting credit losses you will incur and taking those through yield over time. I think you get to the same place. It's a timing thing. However, it feels a little odd to have credit losses impacting yield. So that seems a little odd to us, and we think those should be separated. So overall, I don't think we would view the purchase loans PCD model as favorable. We think purchase loans are no different than originated loans. And, I think it will also create some, complexity and confusion. With that being said, I'm going to pivot a little because there was a point made, I think it was initially by Joseph and then kind of elaborated by Brad, which we haven't really thought through, but it seems somewhat viable to me, whereby you could have, the estimated credit losses going to your equity or OCI and then have some sort of loss emergence hitting the P&L. That seems like a viable solution. And really that's not the view of MetLife or ACLI, but more me just thinking through. And from there, it seems like that would eliminate one of our adjustments to get to our non-GAAP measures, which I think is always, a favorable answer. And, I think that would create consistency. I would actually go a step further. If we're going to entertain something like that, we should think about debt securities as well and try to align all the different financial instruments. So I'll stop there. I don't know if there's questions or you go to the next person, Hillary, but thank you.
Thank you, Lee. So, Chuck. You're on mute, Chuck.
Yeah, so I'm Chuck Williams from Norway Savings Bank, a 1.6 billion community bank, and we've been working on CECL off and on since 2016. The implementation process so far has consumed a lot of resources, and we're still not at the point of running parallel. A lot of time has been spent talking through methodologies and decision points, including qualitative factors, and then documenting those decisions. The flexibility has been appreciated, but at the same time, as Doug mentioned earlier, in a way, it's made it more difficult due to the number of decisions that need to be made. We don't have the resources to devote to this project that some of the larger banks do. And when the pandemic hit last March, we had to put the project off for a few months due to resource constraints. As members of the CECL project team had other priorities throughout the bank, but we do feel that we're back on track now, which is good. So we did form a smaller CECL subgroup, which we've been meeting periodically. So
Perfect. Thank you, Chuck. Really appreciate it. Caleb, do you have specific thoughts on purchased financial assets?
Yeah, sure. So I'm Caleb Brainerd. I'm the head of the Accounting and Transactions Advisory Group for Athene. Like Lee said, I'm representing Athene. Him and I are also representing the ACLI. Really appreciate the opportunity to share our thoughts. Just a quick general observation. We do appreciate the flexibility that was provided in the standard for the implementation and the methodologies that were used. We think that was probably of greatest benefit to the implementation process, and likely will be of greatest benefit, going forward as we proceed, down this journey. As it relates to PCD, and I know a lot of the discussion so far has been, related to loans. From our perspective, PCD became very relevant for us in the security space. So PCD securities, particularly beneficial interests, like Lee said, philosophically, fundamentally, we're challenged conceptually with the concept of PCD securities. When a company is purchasing a security at a steep discount, that steep discount exists, potentially for a variety of reasons, right? Interest rates, and the market's view of credit. And to the extent that a security is discounted significantly due to credit, at that time, the purchaser is, acquiring that at a discount, reflecting the fact that the seller has incurred credit losses. But the PCD model then requires us to gross up our amortized cost basis for expected credit losses, and effectively requires us to hold the seller's realized credit losses on our balance sheet. And we think that provides misleading information. It distorts the size of the allowance for users of the financial statements. A company that is a heavy investor in PCD securities is likely going to present a larger credit allowance, but is not actually reflective at all of what that company's expected losses are going to be. And so, from that perspective, we have challenges with that model. We also experience challenges in implementing the model, specifically as it relates to PCD securities, because at the time of implementation, many of the PCD securities that were purchased, several years ago during the financial crisis, are now in unrealized gain positions, and there was a lot of ambiguity in the guidance as to how to transition, which ultimately led Athene to submit a comment letter in November of 2019, shortly before implementation, seeking further guidance on how to apply the transition, which ultimately led to us concluding that for PCD securities that were in an unrealized gain position at transition, that we should not apply the PCD model, and so no gross up would be applied. We also had issues with the application of the fair value floor and the prospective yield adjustments that are required for beneficial interests when the fair value floor kicks in. We believe that the interaction of the fair value floor and the allowance with yields creates unnecessary volatility that obscures the information that's provided to users and makes it less transparent and less reflective of the economics. For those reasons, we are skeptical about the expansion of the gross up model to all purchased financial assets. We do believe that there's very little difference between a purchased loan and an originated loan, but because of these issues and the fact that effectively by grossing up, you're bifurcating the expected yield between the allowance and your actual interest accretion, and we think that makes information much more confusing to have your yield coming through effectively two different portions of the income statement. But we do appreciate the attempt and the fact that the FASB is looking at trying to solve a problem with the quote unquote CECL double count, specifically as it relates to purchase accounting. We are going to be going through a purchase accounting process here in the very near future. This has been a significant point of discussion for us during our process, and simply put, we don't think that it makes sense to acquire assets at fair value and immediately put up an allowance. So expansion of the gross up methodology would solve that problem, which we appreciate, but we think that it would cause other transparency issues for the go forward financial statements that may be just as bad as the problem that's being solved. So we would be supportive of further looking into this and looking for other potential solutions. And then the last thing that I would say is that we have some concerns in general with the application of CECL and establishment of allowances for assets that are held at fair value on a balance sheet. So whether that's AFS securities or securities that are held at fair value through the income statement, we think that the application of the establishment of allowances for those securities is less meaningful than when you're talking about loans or held to maturity securities. And as it specifically relates to beneficial interests, we believe that the previous model, which was an accrete to expected cash flows model, was a better model, and would welcome a reversion to that. But at a minimum, we would certainly welcome the FASB looking at eliminating the requirement to make prospective yield adjustments when the fair value floor bites, because that at least would eliminate the yield volatility that is nonsensical and non-economical.
Thank you,
With
Caleb.
that, I'll pass it back to you. Thanks, Hillary.
Jason.
Yeah, thanks. So a couple thoughts on PCD that Capital One has. One, we don't love the idea of two models for acquired assets because it's confusing internally to try to explain why the treatment is different, and can imagine it will be externally as well. Something that Catherine mentioned at the very beginning that kind of piqued my interest was equating the PCD definition with the term at-risk loans. And that's not clear whether that's really what's supposed to happen or not, but I think a lot of thoughts is that we're applying this as PCI plus a little bit is what PCD means. And I'm just not sure if that's really the intent or if it was supposed to be, unless it's insignificant, in which case the double count shouldn't matter. It should be under this PCD model. That's not how it's being applied. And so the amount of double count of losses ends up being fairly significant to the overall size of an acquisition because of that. Another thought of definitionally, what's the unit of account? And when it was day one only, it didn't really matter. And I'm speaking specifically about credit cards and revolving facilities, but the recovery cap for unamortized discounts brings in day two accounting considerations. And so did I apply PCD to the credit card account or to the balance? And there's no good answer to that either way. If it's just the balance, then I'm bifurcating credit card balances between PCD and originated, which is extremely complex. If it's to the account, then the PCD designation lasts forever, which also doesn't feel like, especially in thinking about how it's incorporated in regulatory capital, that doesn't feel like that was the intent as well. So if we keep a PCD model and we keep that non-credit discount day two accounting consideration, I think we have to clarify the unit of account for revolving facilities. We would like one model, but there's been debate whether the avoidance of the double count on losses is worth, as people have mentioned, the effect on yield. If on day one you can tell somebody I built $1 million in allowance and ring fence it, and that's what it is. When that $1 million is bleeding in and causing a drag on your margins, it's just not as obvious and not necessarily material to talk about on an ongoing basis, but does reflect that yield, and we don't like that piece. And I think that the last comment I'll make and then turn it to others, but if it's all acquired loans, I like the idea. I think the term seasoning was thrown out there. It just feels like it's like having a model that supports, I'm going to have a non-bank third party originate a loan and then I'll buy it and now I can avoid an allowance bill. This doesn't seem like a good idea. And so like having some like way of applying acquisition accounting and making sure it's not bleeding into a replacement of us originating our own loans would be good.
Thank you, Jason. Linda?
Yeah, I'd like to build on some of the comments that Jason just made. We have not had a lot of experience with PCDs. The pandemic has definitely slowed down the acquisitions of portfolios of loans. But when we do it, it's very frequently credit cards. And I wouldn't think of it as applying PCD to the whole customer. I would think of it as applying to the balance on the loan. And Jason makes the good comment that it's not clear what the right way to look at it is. But if it applies to the balance only, then I think what banks would need to do is establish two accounts for each credit card that gets a PCD designation, so that there would be one that gets the special PCD accounting with the gross up and the amortization of the discounts and premiums and the yield problems, And then you have your regular originated balances, subsequent activity on that credit card account. So it doubles the number of credit card accounts. It makes life much more complex. And that's been true with many aspects of CECL and credit cards. But I don't think that's something that should be ignored. It needs to be thought through. I like the idea of having one model. If I had my choice, I would go to the non-PCD model because that's closer to the originated loan model and would avoid the problems that Jason mentioned that with seasoning. You know, you hold a loan for 2 weeks and then sell it to somebody else so they get a purchase loan. You know, you have to have some sort of rules around that. I agree. That would be important if you went to an all PCD acquisition model. So I'll stop there. Oh, I forgot to say I'm from Citibank.
Oh, thank you, Linda.
Yeah.
Doug?
Yeah, I would agree with what most of the preparers have already said, and that you know, I think one model would certainly be helpful. It would reduce the complexity. I also wanted to comment on kind of the scope issue because I think because of the pandemic and the excess liquidity, I think this will impact many, many, many more institutions that it did prior pandemic, prior excess liquidity, because I think you're finding a lot of institutions, not only because they have excess liquidity, but because of digital lending and, you know, third-party partners and fintechs purchasing loans now, whereas many smaller institutions didn't used to do that. They only originated loans. So that brings the complexity, I think, into kind of more focus, particularly for smaller institutions, because we're going to have to, and a lot of smaller institutions are going to have to deal with this on a frequent basis. And it won't be, you know, kind of a one single acquisition of another institution type of thing where we deal with it all at once. It will be an ongoing issue as we buy participations or we buy, you know, purchase whole loans and so on. So I think that really argues for simplifying the model and choosing one model or the other model. I think, you know, theoretically, it makes sense that when you're purchasing a loan, even if you're purchasing, well, regardless of whether you're purchasing at a premium or a discount, you're probably taking on some additional credit risk. So I would agree, I think, with Linda that I prefer, you know, kind of the PCD accounting where you can deal with it right up front and you know, kind of work with it from there. But I think, you know, kind of the emphasis for my point is that we need to probably choose one model and try to make it as simple as possible because it impacts all sizes of institutions and many, many or more institutions and much more frequently than probably it did 4 or 5 years ago.
Thank you, Doug. And Jay, I believe you have a question for the group.
Yeah, just a clarification question for Jason and Linda. I think I understood what you two were saying, but just want to make sure I clearly understood it. So on credit cards under a PCD model, when you purchase a credit card portfolio, you would apply the credit cards to that outstanding balance as of that date, but those future draws, you wouldn't apply PCD accounting to unless you change the unit of account to a customer or that entire relationship. So that way, whenever there is a future drawdown on that credit card, it still follows the PCD accounting model. So is that what you guys meant on having the change? Okay.
Like it's one financial instrument, it's one data set. I mean, it's the same complexity to some degree that we all debated a couple years ago about credit cards and CECL, but it's, do I have to then bifurcate and come up with some payment allocation method for PCD purchase, the recoup of the discount related to PCD, then the recovery to purchases that were made after the fact, and you know that type of thing just is much more complex than what at least our systems are able to do at this point. I mean, we'd have to come up with a lot of builds to be able to do that.
Yeah, that's right. I agree with Jason. So if you chose the customer as the unit of account, so then you would have the day one PCD accounting like everybody else would. But with every successive purchase, you'd have to do the same kind of a gross up, and you'd have to then figure out how each receivable that's a component of that account gets amortized off over time. And then you run into, can you use an average life for the amortization, or can you not? What's the length of the life of each specific component, each receivable? And we've avoided those sorts of questions with the CECL model for originated loans. And I think that it would be enormously complex, and our system certainly can't handle it at this point. So I would, if we went that way, I would say it's just the originated balance at the date of purchase that you could possibly do the PCD model for.
Thank you. That's helpful.
Jeff?
Yes, thank you. And I also wanted to, thank the FASB staff for the paper they put together for this, roundtable. We thought it was really well written. It was easy to understand and kind of flesh out the issues. So thank you for that. On this issue, I would say the theme for the OCC, and I think I speak for my fellow regulators as well, our position on non-PCD accounting is if it ain't broke, don't fix it. We don't believe that non-PCD accounting is broken. There's nothing here to fix. Although I'm surprised we didn't think doing away with PCD was going to be an option. So we're speaking from the original question of expanding PCD accounting. So non-PCD accounting was thoroughly vetted when CECL was being developed, and we believe the FASB got the answer right the first time. Probably the best explanation of why no changes is needed is found in the basis of conclusion for ASU 2016-13. The issues being raised now are not new. It feels like, I'm watching the same movie that I saw earlier over again. In looking at the three different types of loans, you've got originated loans, non-deteriorated loans, and purchase credit deteriorated loans. And we believe that non-PCD loans are more like originated loans than they are like PCD loans. And so you could go back when you were a kid in school, which one's not like the other? For us, it's the PCD is the one that's not like the other. And if there needs to be a separate accounting model, that's where the line should be drawn. Otherwise you're going to create this incentive for banks to if you expanded it, to purchase loans rather than originate loans. And I worry we'd get in this, you originate loans for me, I'll originate loans for you, and we'll swap. And it just feels like it would be a perverse accounting incentive. Again, we think the board drew the line in the right place. It was extensively deliberated. It was thoroughly vetted. It went through a comprehensive due process. The consequence and alternatives were fully explored. The board made the right decision. And so, just because non-PCD is operating exactly as it was designed, we don't understand what has now changed to cause a need to reconsider, particularly so early in the life of a new standard. Our bank spent a lot of time and effort to implement the standard, and changing it now would be costly, operationally burdensome, and really not needed or appropriate. And let's see, I'll skip over that point in the interest of time. If you do go back, though, and look at the board's basis conclusion, they decided not to extend the gross-up approach to all purchase assets because they said the credit risk may be difficult to reliably isolate from other discounts related to the purchase price when it's insignificant, and the benefits would not justify the incremental costs associated with the requirement to separate credit and non-credit, and then to allocate the credit discount to each loan when the amounts are insignificant, and the accretion of that discounted income due to credit would be insignificant. And the last point I want to make is in that third example of applying PCD accounting to loans purchased at par. The first line in paragraph 30 of that paper gave me chills. And it says, in this acquisition, the non-credit premium represents the deferred provision expense on this pool of loans. And we do not like deferring provision expense at the regulators. So here the credit loss expense is obscured as a yield adjustment, reported as part of interest income. Over time, it's not recognized as a credit loss expense. And so that, to us, this really represents a step backwards. It's worse than the too little too late of the incurred model that CECL was designed to address. Thank you.
Thank you, Jeff. Mario?
Hi, Mario Mastrantoni with Wells Fargo. Just a couple of brief comments. We've had limited experience with PCD accounting at Wells Fargo, but we would not object to the expansion, certainly, although we would recommend that it only apply to loans, and we would recommend that you exclude securities. I think that's an unnecessary complication. Would be interested, I assume if we expand the model, that the PCD designation would no longer be necessary. In other words, you wouldn't have to continue to assess more than insignificant credit deterioration if you're applying it to all purchase loans. And to address some of the comments that have been made, and particularly Jeff's, and the seasoning, I mean, I don't think banks will be swapping loans. I think that can be fixed. I think, standard setting to address anti-abuse provisions is the worst kind of standard setting, and it never results in good outcomes, and there are always unintended consequences. I think the FASB can create a principle. The whole standard is based on principle that assets that are acquired shortly after origination, and we can define what shortly after means for ourselves, would be treated as originated loans. And I don't think you have that issue. Those are all the comments that I have.
Thank you. Don.
Hi. Yeah, we don't have a lot of experience with PCs either. But, it was interesting reading through the proposal and thinking through it a bit. And, going back to that sort of upfront decision, which is, admittedly highly judgmental, whether it's a PCD or a non-PCD, ideally, I think you'd like, as actuals eventually happen on those securities, you'd get to the same accounting result, once everything comes through and it's fully collected on. And you hate to get to a different accounting result because of an upfront judgmental decision that went one way or the other. As I sort of think about the discount, though, there's a lot of reference to it being a double count, and we do a loss provision, and you're paying that already through on the discount. But I'm just not sure if I think of the discount any different than just as a form of compensation for the additional risk. And if it were a higher coupon, we wouldn't be thinking about it as being a double count. And that's certainly the originated model, right, where we might have high originated loans, we still take a credit loss reserve. The risk compensation is coming through that higher APR, and the discount that we're buying a PCD at is just trying to get to a comparable yield that a newly originated security would be at. So I think that there is benefit to have just one model, but I would lean towards something that looks more like the originated model, and not sort of move all of the purchased towards the PCD model. And I think that gets us a little more common across all types of purchased and originated loans, and also addresses some of the systems implementation issues that we would have, trying to bifurcate purchase discounts between an accretable portion and an amount that doesn't accrete and it goes into a loss reserve. There's certainly be a lot of implications that would come with that as well.
Thank you. Mark?
Thank you. And again, this is Mark from Ally. Just a couple of thoughts, on Jeff's comment about originations and gamesmanship. I agree completely with Mario. I think, that's what the seasoning consideration might be. You could do some anti-abuse. I don't think that would be as big an issue as, might be considered. On Linda and Jason's comments about the issues, and I'm not ignoring, we don't have credit card, but I understand the credit card challenges. If you go back to the PCI standard, revolving loans were scoped out of PCI. You could do that with a scope out. You could move those out. Revolving loans would not be considered under a said model. And then I just go back to, again, Mario's comments. I think personally, and we at Ally have discussed this at length, even though we haven't done a big acquisition, we're very cognizant of that CECL double count. We don't like the idea of having it. So we would be supportive of moving everything to the PCD model, calling it an acquisition model, not a PCD model, because as Mario said, you really don't have to assess whether there's credit deterioration. You're just applying that model to all acquired loans.
Thank you. Mark Northern?
Thanks. Hi, Mark Northern with KPMG. Just a couple of things I wanted to say up front. One, just appreciate the post-implementation review process that you're undertaking. I think it's a very important process. And also at the outset, I just wanted to say, we believe there's a lot of importance in just the inherent stability in financial reporting, right? There's benefit in that. both preparers have, recently incurred a lot of costs related to change with CECL. I think investors are still getting used to the, the financial reporting that results from the CECL model, and there's obviously an inherent benefit in trying to maintain some stability at this point. But I also think, as you're doing right now, that there's certainly room to talk about how the standard and the financial reporting can be improved in a way that doesn't, create a lot of additional instability. On the purchase loan specifically, I think I'm going to end up echoing some of the comments that Caleb started and Jeff Geer picked up on. When we talk about a proposal that would extend PCD accounting to all purchase loans, but just stop there, the thing that stands out the most to me is that proposal would result in dissimilar accounting for similar economic transactions, and specifically dissimilar accounting for purchase loans and for originated loans, even though those may be in substance the same asset. And the dissimilarity in accounting, as people have picked up on, it really arises from two things. One, an origination of a loan would still result in a day one loss. A purchase loan would not. But then, in addition, a purchase loan would, its yield going forward would be netted down by a credit component, whereas for an originated loan, it would not. And so, on the latter point, that seems like it could create sort of confusing financial reporting, where you've got different types of yields going through for similar assets, which may make it difficult for investors to really understand what is a representative yield for that portfolio going forward, and then may necessitate a lot of separate reporting of the acquired portfolio that's running off versus the originated portfolio. And so I think that there's I think I would really caution against, a proposal that would result in that sort of dissimilar accounting for purchase loans and originated loans. Some people have referred, in different ways. I think Jeff brought up the potential for structuring. I think that when we change the accounting standards in a way that results in dissimilar accounting for similar economic transactions, it will open the door to structuring for those that don't want a day one loss on originated loans, to try and find a structure that would enable them to account for those as purchase loans without changing the economics, and could result in a need for the FASB to end up having to promulgate literature about what is an origination versus what is a purchase, because we have drawn this distinction in the accounting. So I think there are some real drawbacks to the to the approach that's being, or to the accounting that, is in the CECL standard today around purchases. I think a lot of those were debated in the deliberation process. And I think, it makes sense to try and improve the accounting. I would just really encourage the FASB to think about solutions that don't result in this dissimilar accounting for similar economic transactions. And I'll mention just one point on the scoping of what gets PCD accounting. I think a lot of the challenges today are coming from the fact that PCD, purchase credit deteriorated, involves some relative comparison of the credit quality at origination against the credit quality at acquisition. That can be very challenging. It can be very dependent on what information is available from one acquisition to another, which can cause a lot of differences and a lot of disparity between entities. And so, certainly thinking about scoping alternatives that would be based on just the credit quality at acquisition would help resolve, I think, some of those disparities, so that people could look and say, well, I'm going to apply it to things that are purchased impaired, plus maybe past due, assets that are on non-accrual. I think that would result in some more consistency in scoping. So I think there are some, there's I think available to address, some of the concerns that folks have raised. But I don't think I would definitely encourage just people to think about maybe smaller changes versus larger scale changes that create differences between transactions, between similar transactions. Thank you.
Thank you, Mark. And I know we're coming up on our time related to this section, but I know we have a few more folks with their hands up, so we'll try and get to you, and then we'll do a quick break because I know everyone has been sitting for 2 hours. I realize that's very challenging in this environment, but maybe I can go to Jay.
Yeah, thank you, Hillary. I'll make this brief. I think we have a little bit of unique perspective just given the merger of equals that we closed just prior to the effective date of CECL, and then the materiality of our purchase, our mark on the acquired loans. I think that Saul and Catherine and Louis made the points very well in terms of the potential confusion to the user and investor community in terms of the impact of the double count. And I think when we advocate for the expansion of the PCD accounting model to all acquired loans, it is set in the context of a material business combination where the impact of the underlying double count of the credit component, which is reliably measured in the context of a fair valuation of an acquired portfolio in the context of a business combination. The double count between that and its significance relative to the additional provision that's provided on top of that. One of the things that we've attempted to do, which hopefully has been helpful, is to provide further context to investors in our and this became part of our quarterly earnings deck as early as the first quarter of last year, is just to provide additional context on the embedded loss absorbency, because the underlying credit component of your total purchase accounting mark, to the extent that as you begin to incur actual charge-offs on acquired loans, that the unamortized balance provides dollar for dollar loss absorbency that then is not needed in terms of the duplicate provision that you provided for that same loss risk, and in turn then that would reverse back out through the income statement. And so I think just being prepared for banks that are contemplating or in the midst of material business combinations to provide additional insight into like the underlying loss absorbency potential of the unamortized fair value mark is something to consider. Just one other aspect of it that we and Jay, I'll direct this to you, that we would welcome the opportunity to further interact on, that we found challenging specifically within the application of PCD accounting, relates to acquired loans that had a partial charge off prior to the merger date. Under our application of PCD, we essentially reverse those partial charge-offs and replace them with a credit mark. However, what that created was basically day one charge-off exposure. And so, we found that confusing to both internal and external, both internally and then to external constituents, in the sense that it was essentially resulted in having to charge off loans that had already previously been charged off by the acquiree from an accounting perspective, and one that didn't necessarily run through provision expense originally. So that's something that we would ask for clarification on, is the potential to clarify that the day one gross up would not be required for for amounts that have been charged off previously by the acquiree, where we would agree with that treatment.
Thank you, Jay. Jim, thanks. I see you have a hand up.
Yeah, I just wanted to follow up with the users really quickly. Hopefully it's a quick question for them on the question about the operational difficulties of applying the PCD model to revolving lines of credit, credit cards, et cetera. If we were to exclude let's say we expanded the scope of PCD but excluded revolving lines, would that frustrate users' analysis given sort of the operational challenges you've heard?
Any thoughts from our user group?
Yeah, this is Louis. I think it would, to some degree, if the consumer loans were, or the revolving loans were a big component. I think it would create something that merited special attention. But if that exception was explained and some of the differences quantified, I think we could live with that. I don't think it's a huge deal breaker, excuse the pun, but we'll have to pay special attention to it.
Any other thoughts from our users? Okay, then I think what we'll do is, in Sydney and Graham, maybe if you could provide your thoughts, and then we will go to a break. That makes sense. So Sydney?
I thought about, why do we have PCD accounting? And I went all the way back and was thinking this through. So it goes all the way back to Practice Bulletin 6, right? That was issued back in the late 80s, right after the thrift crisis. And it was issued because there were loans being acquired at very deep discounts. And so the objective was to not over-accrete those discounts. So that's how we ended up with PB6 and then SOP 033. So I remember at the time, the criteria in 033, the evidence of credit deterioration was actually included in the standard to avoid buying of allowances. And so then I kind of walked this forward, and what was the board trying to do? Well, people found PCI accounting complicated. And so with PCD, as part of CECL, I think the board was really looking to simplify that accounting. But then if you step back and say, okay, well then, is that distinction between PCD and non-PCD relevant today? And personally, for me, it's a different objective. So I think, well, what we were trying to do is simplify the accounting. It's just a different objective today. And I think it's also somewhat counterintuitive, so that, and by the way, we now have like buying of allowances, right? Because that's what now happens with PCD. So I think expanding it, so all acquired assets, probably in a business combination, would leave the double count. And the only downside that I can think of is then you're potentially back to the gamesmanship of buying allowances. But again, I think for me, that's how I got to PCD for all acquired assets. Now, if you don't like the PCD model, that's something completely different. But to me, the distinction isn't relevant.
Thank you, Sydney. And Graham, it looks like you took your hand down. And if it's all right, in the interest of time, I would like to give everyone a quick break here. If we could all take a break and come back at 11:15, that will give us 45 minutes to cover TDRs, which I know is another area of interest that we're excited to hear everyone's feedback on. So we'll be back at 11:15. All right, well, I think we will move on to topic 3, which is troubled debt restructurings, the accounting for troubled debt restructurings after the adoption of CECL. So I'll ask Marla to do just a brief tee up before we get into observations.
Great, thanks, Hillary. Through feedback generated from stakeholders during the PIR process and through targeted outreach performed with preparers at our financial institutions and insurance companies, as well as regulators and practitioners, the staff received feedback that TDR accounting may no longer provide decision-useful information to financial statement users for entities that have adopted CECL, and that the cost of performing TDR accounting and generating the required disclosures for TDRs may not justify the benefits of providing this information. Although TDR accounting is well understood, there is complexity in determining whether a modification represents a TDR and in subsequent measurement of a loan modified as a TDR. The staff also received feedback that certain disclosure improvements may be able to provide more useful information than TDR designation. In the absence of TDR accounting, the staff thinks that all loan modifications would have to be assessed under the loan modification guidance in subtopic 31020 to determine if the modification results in a new loan or a continuation of the existing loan. It's not entirely clear whether this alternative would be cost beneficial. There may be complexity associated with applying current modification accounting, and therefore the potential solution identified by the staff would replace complexity in applying TDR accounting with potential complexity in applying modification accounting. This, coupled with some of the modified disclosure requirements that may be necessary if TDR designation were eliminated for creditors, could potentially lead to the solution being more costly and complex than TDR required under current GAAP. So I'll turn it back over to Hillary to lead the discussion.
Thanks, Marla. So we are interested in getting your feedback on TDR accounting, including whether or not the designation provides decision useful information, and if applying the modification accounting to all modifications that would have been TDRs would be a cost beneficial approach. So maybe I'll start with Mario.
Thank you, Hillary. I think I don't think there's a lot of complexity in the modification model. I think we certainly would support the elimination of TDRs. We don't think they're necessary under the CECL model. We don't think the distinction provides, excuse me, useful information. So eliminating the recognition and measurement component of TDRs, I think, would be beneficial. I think we do believe that disclosure on modifications is important, particularly disclosures related to borrowers that are troubled or experiencing financial difficulty. So I don't think we can get away from at least that assessment. What we're really talking about is getting rid of the assessment of a concession and perhaps even the cumulative effect of concessions. I think that's an issue that's come up and has been more prominent recently with all these COVID modifications and how that impacts that assessment pre and post. So I think there's probably a discussion around disclosures in terms of whether the current disclosures on modifications are adequate or whether they need to be enhanced. As it relates to the new loan versus modification model, again, I don't think you're exchanging one set of complexity for another. I think we can continue to live with the same model. I think it's as simple as just changing the words from troubled debt restructuring to borrower experiencing financial difficulty, or just leaning on the market rate requirements. I'm not aware of any loans to troubled borrowers that are made at market rates. So I don't think that's a high hurdle to overcome. So those would sort of be the comments that I would have.
Thank you. Chris?
Yeah, hi, Chris Lynch from Bank of America. I would agree with what Mario said. I think, one, if you look back at TDR accounting, I think it was a whole lot more meaningful when we were in an incurred world where you're moving from a loss emergence period to a lifetime loss estimate. But that's really not that relevant under CECL today. So I think that piece has gone away. And I do think when you get to disclosures, I mean, look at the past 5 quarters, we really haven't been focused on TDR disclosures. We've been focused on the modification disclosures around COVID, and they have been voluntary. So it just shows you that, TDRs in this environment is less relevant and modifications more relevant. So we would agree with what Mario said.
Thank you. Mark?
Yeah, I'll just echo the measurement comments that both Mario and Chris said. The measurement is certainly not useful any longer now that everything is on a lifetime model. With respect to identification of the loan as a continuation of the old loan or a new loan, I wonder if there can be some consideration for, I'll call it more of a principle-based determination, right? Rather than doing that 10% test on all consumer loans, which I think most of us probably, don't always do. I think, our loss mitigation teams, as we look at these loans, we know which loans we're modifying in a loss situation versus which loans we're truly refinancing or are, really in a lot of ways a new loan. So I wonder if we can build a principle rather than a quantitative test to make that determination, but otherwise agree with everything that's been said so far.
Thank you. Rebecca?
Hi, thank you. Becky Carey from JP Morgan Chase. Again, thank you for having all of us. I would, on the topic of measurement, definitely echo the comments that Mario and Chris each made. We would support eliminating the measurement requirements, and certainly think that once a preparer is in a CECL model, there's limited utility from a measurement perspective. Maybe a little bit more on whether or not we should then turn to apply the modification versus extinguishment tests to these. And I like the way that Mario described it, modifications for troubled borrowers. Another potential unintended consequence of perhaps applying that test would be that many of these modifications might be deemed significant enough in order to call this an extinguishment. And then when you think about the vintage disclosures that came in as a requirement of CECL, I wonder if it would have the unintended consequence of perhaps reducing the utility of those vintage disclosures. When you think about why we would be doing one of these modifications for a troubled borrower, we're essentially doing this as a creditor in order to improve our opportunity for recovering that initial investment. So I think the vintage disclosures and their usefulness in that framework should be considered.
Thank you. Laura.
Hi, thank you, Hillary. Hi, this is Laura Lilosian from the Federal Reserve Board. So I'm sharing, coming at it from a regulatory point of view. And I'll share my perspective, which is really rooted in my experience in the crisis last year. We spent a significant amount of time talking about TDRs with a wide range of stakeholders during 2020. What it is, what it isn't, the impact of the CARES Act relief, how it fits in with our examination process, what it means for the allowance, how to report it. And I was just so surprised by all the misconceptions about TDRs. And I think some of them are still out there despite all our education and outreach efforts. And I think all the focus on TDRs and that label somewhat checked one of our main messages throughout the crisis, which was to encourage banks to work with their customers and borrowers. And just yesterday, Vice Chair Quarles reiterated that message during a hearing with the House Committee on Financial Services when he was being asked about, what he thinks about loan modification. So I think if removing the TDR label helps open that up in that regard, then I'm in favor of exploring it further under CECL. I mean, as mentioned before, I think from a measurement standpoint, there's much less of an impact. That said, I agree with Mario and Rebecca and others who have said that even if you remove the TDR label, we would still want to continue to see robust and consistent disclosure requirements around loan modifications. And I think it's a real opportunity for us to build on existing disclosure requirements and also include, additional more uniform information about types of modification and performance that would allow users of the financial statements to better assess the ultimate success of a modification. And as mentioned, some of the banks, were voluntarily disclosing this last year, particularly in Q2, Q3 at the height of all this. It would be nice to see this in a more uniform, consistent way in the financials. But, I guess the challenge would be not to, do it in a way so it doesn't overburden preparers, particularly community banks. But as regulators, we ultimately care about loan modifications and being able to have these disclosures. It's an additional data point for us on an institution's credit risk management practices and overall credit quality of an institution.
Thank you. Don.
Hi, so I agree with others on the day one measurement loss and the removal of that. I don't think that that's very useful, especially now in our CECL world that we're in. I do have some concerns, I guess, about carrying over some of the disclosure, expanding disclosures around modifications, and just thinking of what a modification is, and referring back to the diagram that's in the materials, and many cases these modifications are very insignificant. So to expand disclosures around that portfolio of loans doesn't seem like it's very, very beneficial. And I think there's probably sufficient information already provided through the existing CECL disclosures.
Thank you, Don. Stavros.
Yeah, I can be quick, Hillary. We would concur with the notion that for those that are under CECL, from a measurement perspective, a TDR is just not as meaningful as it was under the incurred loss model, and would highlight that really throughout 2020, a number of banks put a lot of voluntary disclosures around modifications that we thought were helpful and provided a pretty good framework for period modification disclosures around what users might find helpful. But I would be interested in hearing from the users as well in terms of what they view as being helpful.
Absolutely. And maybe we can open it up for, from the user's perspective of, what information would be helpful if we were to remove the TDR designation. Do we have any feedback from Catherine? Catherine, I see your hand up.
I mean, I would just say it was really helpful throughout the past year when we saw disclosures on modifications, which modifications were principal, interest, both. So I think that disclosure was helpful. Of course, the loan types as well was helpful. But I would agree on all the commentary on TDRs not being as relevant under CECL as well.
Great. Saul or Joel?
Yeah, I agree. I think, I'm indifferent in TDR accounting, but I found the information and disclosures helpful. And the total number of accommodations, the balances, the percentage that are current, the categorization by type, all of that, I think that is useful information, and obviously was much more top of mind for investors and analysts in the second and third quarter, and that's kind of become less relevant given how good credit has been. But as ongoing disclosure, I think it's very helpful. I would certainly be more in favor of having some sort of standardization.
Great. Louis or Joe?
This is Joe Stephen. I would agree with Mario and Chris. I think the TDR designation has probably outlived its useful life. I think the banks were very good in their disclosures on modifications. And if 2020 teaches us anything, we obviously had 2 stress tests for the largest banks and an actual pandemic. And the industry was soundly profitable while doubling loan loss reserves. I just think requiring more disclosures, I think at some point in time, I think the banks had more than enough disclosures.
Thank you.
Just to chime in here, this is Louis Lau. I think for the context of US banks, when your TDR is less than 1%, it's really not material for an analyst to look at. Some of the other countries like Indonesia or India, where restructuring is a persistent issue, where TDRs are 6 to 8% of gross loans, that's something that we need to look at and adjust. So for a US bank context, it's not very relevant. If you go back to the financial crisis of 2009, some of the consumer banks had TDRs of 2% or more. And I would say going back to the subprime crisis, that was more relevant. But today it would be much less relevant. And I also agree, that the modification disclosures, some of them were really impressive. We saw what kind of terms were modified, and then also the duration of the modification, and also the percentage of the modified loans that were current, past due, even up to 90 days. Some of the banks had really good disclosure on loan modifications, and loan modifications were 9 to 11% of the total loan book, which was material. So as long as such information on modifications continues to be available, then I think from a user perspective, that would be very, very helpful.
Great. Thank you. Linda?
Yeah, I'm all in favor of having good disclosures, and I agree with all the comments that have been made so far. They've all been very consistent. I just want to add a couple of points. One of the things, or two of the things that have been troublesome about TDRs is this concept of once a TDR, always a TDR. So where you at one point had a troubled borrower, but maybe the borrower had lost their job but now they're employed and they've been performing, the concept that you have to continue to measure their allowance in a special way for the life of the loan doesn't make a lot of sense. The other concept relating to TDRs is this concept in CECL of a reasonably expected TDR and needing to use that to determine the life of the asset and then the allowance. Well, number one, it's pretty difficult to figure out what's a reasonably expected TDR. So there are difficulties there. And secondly, even if you decide that it is a reasonably expected TDR, it only matters if your modification extends the life of the loan, because that would extend the life of the contract, which would need to be subject to the CECL reserve. So I think it's a provision that really isn't very useful and should be struck.
Thank you. John Rieger?
Hi, thanks. As a regulator, I'm hesitant to say that we can do away with the TDR classification. I understand it from a measurement perspective, especially with the larger institutions. But my concern is that we've gone through periods of time in the past where there's just been a concept of extend and pretend, and the TDR classification is a way to help smaller institutions into being required to identify those modifications that may or may not be at market rate and appropriate. And so I'm hesitant to do away with it. I understand from a measurement perspective, CECL in theory neutralizes the provisioning side of it, but I am concerned maybe there's another category or disclosure that the FASB can work on that would help us identify those loans that may or may not be at a market rate. And so I mean that's my 2 cents worth.
Thank you. Chip?
Yeah, I think we would certainly be supportive of, removing TDRs as a concept that drives, measurement and classification. And I do think you could replace it, similar to what Mario said, with more of a judgmental provision around when you're making modifications to borrowers that are experiencing financial difficulty. I mean, being able to identify when modifications are being made to borrowers that are having financial difficulty, that'll still be important, to John's point, in calculating the allowance, and controls and processes can be built around those. And then I think those same controls and processes that are helping identify that to make sure the allowance is being calculated could be leveraged to the concept Mario raised with, we could change the modification guidance to just saying, it's not a new loan if it's a TDR, to if it's a loan that's being modified with financial difficulty, to borrowers with financial difficulty, and that could similarly spring into the disclosure. So I think there is still a framework there that would allow for application across the things that we've talked about. The only other thing that I would observe is, I think that this is an amendment that could even be made to the literature in isolation. It doesn't necessarily need to wait for other changes to the model that we would be contemplating as part of the post-implementation review process or any other process. I do think this is a discrete item that could be done. I think it could be done fairly quickly, and I think it would provide some relief to people and processes, and I think that would be a good idea.
Thank you. Jay, I see you have a hand up. You have a question?
Yeah, just a question for an analyst. Over the last year or so, or last 5 quarters, as someone mentioned, what was your take on the disclosures that you've seen related to loan modifications? Have you found that the information was comparable? What kind of quality were you seeing? That sort of question. So just curious what the analysts think about that.
Jay, I think, as I mentioned, I think the disclosures have been pretty good, and they've been, there's some differences in disclosures, and I don't have all the disclosures for all the banks that I cover at fingertips, but they're pretty consistent in terms of the number of often, well, not always, but the number of loans modified, balances, the percent of loans that are been modified that are current, the percentage of accounts who have exited deferral. There's some differences, but in general, the evolution, just simply the evolution of the balance, the balance by type, and who's making payments, or the percentage that are current. All that stuff is I personally think it's been pretty helpful. And there's some differences, like I said, but it's been fairly consistent across the bigger banks in terms of what they're providing.
I would agree. I'd say that the disclosures were generally consistent and very helpful. A lot of times we would get them in presentations versus in press releases. which was great. And they gave a lot. There was a lot of data given. I think very early on, loan modification was a very big focus in the investor community, and I think the banks responded very quickly to that. And so I found all the disclosures really helpful. But again, I think on knowing principal, interest, loan type, and kind of seeing the progression of what's coming in and what's coming off of modification is very helpful.
Yeah, I won't repeat what Saul and Catherine has mentioned, but for us, we're just trying to get an overall sense of the repayment status of the modified loans. And if we see the repayment status being low or deteriorating, then we would top up with an additional adjustment on the firm value to deduct that. But the disclosures have been impressive. I actually was happy that I got more than what I expected.
Yeah, and I'll just make one more point. I think it did into the third quarter and fall. It did. The evolution of that was something investors really were asking about, caring about. And it did give investors a sense of comfort that credit was holding in there, very well. So it was a useful disclosure that I think helped folks get comfortable with credit quality evolution.
Thank you. And Mario, do you want to jump in?
Thank you, Hillary. I do. I just want to comment on the disclosure commentary. I mean, I think there are a lot of things to keep in perspective here. I think the COVID situation was a very public, large, discrete event, and I think companies reacted really well to providing that information. And I think from the FASB standpoint, I mean, I think the SEC kind of pushes all the public registrants to make sure that you've got transparent and voluntary disclosure, right? And so we've all done that. So you have to think about whether or not companies that are not SEC registrants would provide the same level of information on a voluntary basis. At the same time, I would caution that you should not over-engineer any new disclosures. I think I'd be interested to hear from the analysts what they think about the current disclosures for TDRs, because I think they're pretty onerous, trying to provide sort of the financial effects of those modifications. And many times A plus B doesn't equal C because you make multiple modifications to the same loan. And so trying to add all that information across doesn't always kind of make sense, and it's very difficult to track and calculate. What I would envision, and I heard some of the commentary earlier, I think most companies have workout programs, they have loss mitigation programs, so it's not going to be that hard to identify what types of loans analysts and others are going to be interested in understanding in terms of modifications. So if you're isolating those types of populations, I think any new disclosure requirements or replacement, I'll call them replacement disclosures, can be based on that type of a principle in terms of what financial difficulty is and isn't, and what those modifications may or may not be. I think qualitative disclosures on what that is, the amount of loans that are being modified, and maybe some qualitative discussion around the types of modifications, I think would be important. But if you're not talking about large discrete events, trying to provide that same disclosure that we all just provided for COVID would be difficult. We don't want to get into once a TDR, always a TDR through disclosure, because we have to continue to provide cumulative effect of all these modifications we made through the life cycle of all these loan portfolios. I think that would be very difficult, and I'm not sure how useful it would be. So I just wanted to make that point.
Thank you. And Joe, did you want to jump in?
In general, Catherine's comment, I mean, I think I would agree with everybody's comments so far. No need to take time.
Okay, thank you, Joe. Mark Northern?
Yeah, I want to weigh in. I actually do think that TDR accounting has some benefit. I just think that there are some strong indications that the costs are significantly outweighing those benefits. So, I mean, the benefit of TDR accounting is it gives us a model, and I think it sort of has a noble purpose. It gives us a model where the economic cost of a modification to a troubled borrower is measured, and it's agnostic to the form. So it's agnostic as to whether that concession was granted in the form of principal forgiveness, an interest rate concession, or a payment deferral. I mean, there's nothing else in CECL that's going to provide that sort of guidance. And so, at its best, it sort of gives an idea, a measurement of the economic cost of the concessions that were granted to troubled borrowers that would allow, I think, some information about evaluating credit quality trends, if you could look at those period over period. But we pulled we pulled a small number of disclosures. It looks like very few financial institutions are disclosing that allowance effect of TDRs. They are disclosing a lot of other very meaningful information that can help users understand the impact of TDR and the impact on financial performance going forward. So that's already being disclosed, even though the allowance effect is not. And so, continuing to calculate these net present value effects in the allowance, I think there is a real question as to, the costs are very tangible, they're very high. And so I think there's a real question about, whether the costs are really outweighing the benefits with respect to the measurement right now. I do think there will need to be some sort of designation of loans made, because I think the footnote disclosure should relate solely to modifications of troubled borrowers. Expanding that to modifications more broadly, I'm not sure what that would add from a financial reporting standpoint. So it seems like there would still need to be some troubled borrower designation used to differentiate types of modifications. But one specific ask I'd make, sometimes the preparers who use a discounted cash flow approach are often overlooked. And so, if there is a change made to remove the measurement guidance, don't forget about the preparers that use a discounted cash flow approach to calculate the allowance. If they don't manipulate or mitigate or provide some sort of manipulation in their model, they will still pick up the impact of TDRs. And so I think the board would need to have some thought specifically to discounted cash flow preparers, and whether or not they want them to manipulate the model in some way to remove the effects of TDRs, or whether this is sort of an intentional and acceptable difference that would be built into the model between DCF preparers and non-DCF preparers. I would say that this would probably be the largest difference between DCF preparers and non-DCF preparers. So just a specific ask to, think specifically about the DCF folks. Thank you.
Thank you, Mark. John?
Thanks. It's John from Deloitte. I agree with most everybody's comments. I think TDRs have kind of outlived their usefulness as far as the accounting goes. I think with CECL, the FASB justifiably, and I think rightly, said, we're not going to tell you how you need to calculate your credit losses. We're going to come up with a principle. And then we kind of ran into this issue where TDR accounting made that impossible for interest rate concessions. And I think what came out of a lot of the TRG discussions was even just how entities thought about losses and thought about risks, not collecting contractual interest that might accrue in the future that I'm not going to collect anyways isn't really credit loss. They're kind of looking at how much of my investment did I not get back? How much of what I lent did I not get back? And you're really trying to decide between what is appropriate yields versus what's a credit loss. And the more that we move away from actually how they think about losses and being able to use historical loss data applied to their portfolios outside of a DCF scenario, the more you realize it kind of makes it difficult for them to use their own data to come up with the credit losses. So I just think it's kind of inconsistent with CECL to maintain this notion for interest rate concessions. And to echo what Chip said, I think anything the FASB could do to make this go away as soon as possible would be greatly appreciated.
Thank you. Jeff?
Thanks, Hillary. So my theme here for the OCC's theme on TDR accounting would be, let's make sure that the cure isn't worse than the condition we're trying to address. And today we've only heard from the bigger banks and analysts and auditors of bigger banks. And so we understand the support for removing TDRs as being less relevant under CECL, and we could be open to changes to current TDR accounting. However, at OCC, we have reservations about moving forward with such an idea for two main reasons. One is, first, for community banks, TDR accounting has served as a trigger for recognizing credit losses. And so, obviously our hope is that CECL is going to result in earlier credit loss recognition, not later, and worry removing that backstop could further delay recognition of credit losses at some smaller institutions. And second, before evaluating the merits of doing away with TDRs, I need to more fully understand what the replacement would be. I think we need to understand what that replacement is, and it seemed to me like in the paper that it was only looking to the current non-TDR modification guidance and kind of lumping those together. And maybe I'm misreading the intent, but I think that those two different kinds of modifications are very different. One done in the ordinary course of business at a market rate is very different from one done to a troubled borrower at a non-market rate. So I think they would have to be segregated in terms of their disclosures. As far as TDRs being a triggering event, again, for some community banks, we've seen that. I've seen that in my whole 36 years of doing this. We've seen it in recent letters from their trade organizations. We've seen it in the push for legislation from Congress to provide relief to TDRs, because unfortunately, some have the view that that means if it's not a TDR, you don't need an appropriate allowance. You don't need to put it on non-accrual. You don't need to charge off uncollectible amounts, and you don't need to assign the appropriate credit risk rating. And we certainly don't support or condone that practice. We've tried to dispel that notion very frequently, but I'm afraid the problem is just not going to magically go away with the adoption of CECL. And so I think I'll stop there. One other point. It's not clear to me when I'm looking at the flow chart in the appendix if you would actually ever get to the 10% test, or if you would say, most TDRs would fail the favorable rate, but I don't think that there is a rate for those kinds of loans. So I think it's hard to measure that first criteria. If you have a troubled borrower, banks don't typically make loans to those guys. So what a market rate is for that is hard to discern. But I don't find the 10% test, to me, that seems actually more difficult than current TDR accounting for our little banks, rather than the TDR test. And in fact, we often don't see that modification guidance being used in practice in the retail portfolio. That they're just kind of presumption that those are new loans. Thank you.
Thank you, Jeff. Doug?
As a smaller institution, I think I'd like to respond to some of the concerns that John and Jeff raised. I fully agree that if we're modifying loans for borrowers that are troubled, that we need to account for that in the allowance. I think the challenge with the TDR designation goes back to once a TDR, always a TDR, because I think what we end up doing is we end up classifying borrowers as TDRs. And then 10 years later, we're still carrying those loans as TDRs and still representing those loans as TDRs. And technically under the guidance, they are. But clearly those loans have paid as agreed for 10 years. And therefore, I guess the additional operational cost and the additional complexity and trying to explain to our board and our investors why these loans are quote unquote still troubled debt is very difficult. So I think there's other ways that we can approach, I guess, the allowance and making sure that we're reserving on modified loans. It's not that hard, honestly, to pull up a list of loans for which modifications are made over the past year, if you're from an examiner standpoint, and take a look and ask and dive into what the institution has done with those in terms of the allowance. So I think just some additional rulemaking or some additional procedures, if that's the biggest concern, is making sure that we're reflecting an appropriate allowance for those borrowers can be handled in different ways without the operational complexity and without, honestly, the disclosure complexity and the investor confusion around why is this loan that was made in 2008 and modified in 2011 and has paid as agreed for 10 years, still classified as a troubled debt restructure now. So I would be fully supportive of eliminating the TDR designation and taking a look at both, some potential additional disclosure requirements around modifications, as well as ensuring, there is a process by which institutions are taking a look and considering the allowance impacts of modifying loans for troubled borrowers.
Thank you so much. Graham?
Thanks, Hillary. Yeah, and just one last point, and really want to echo something that Mark mentioned, which is, I think we are going to lose a little bit in the TDR if TDRs go away, because that measurement of that economic loss will sort of disappear from accounting. But I think in our outreach, we found that that's not a big area of focus for either our clients, investors, or their boards. So while I think that's going away, it seems like the cost benefit is probably there. And I think on the cost side, we do spend a lot of time in our audits auditing making sure that our clients are identifying TDRs. Our clients are spending a lot of time having processes stood up to make sure they're identifying TDRs. And as everyone's mentioned, this is all for something that it seems like other disclosures seem to cover the relevant information, and it doesn't impact measurement. So I think to the degree that, and in a year like this, you think about annual reporters where they're going to capture a ton of restructuring activity at the end of this year, to the degree that if there's going to be a change, if it can happen quickly, that would provide a significant amount of operational cost relief for a lot of preparers.
Thank you, Graham. And Sue, I see you have your hand up.
Yeah, I just had a quick question, and maybe it's for the investors. Mario coined the phrase borrower experiencing financial difficulty, which I thought was a nice phraseology, if you will. And Jeff Geer talked a little bit about disaggregating some of the information we may get on modifications. If we were to put disclosures in for modifications on a go-forward basis between ordinary and troubled. And I just wondered what level of disaggregation, I understand that today, there's been a lot of voluntary disclosures around modifications because of the pandemic. But on a go-forward basis, the challenge that we will always have is consistency amongst borrowers, or amongst the banks. And so I wondered, from an investor perspective, what level of disaggregation would they expect?
And start, I think very simply, I haven't found a lot of help out of the current TDR disclosures because, to some of the points we've made earlier, there hasn't been a lot of movement in TDRs because of the whole concept was a TDR, always a TDR. So because of that, I kind of see TDRs as a bucket, make sure it's not a really large number, and then I kind of move on. And so what I focus more on as an analyst trying to watch credit migration is I look at movements from watch into criticized into classified, and I use that as a better gauge as to credit migration versus anything on TDRs. So I think no matter what you ultimately decide on in terms of what we disclose for modifications, know that investors are more looking at the migration in and out of that asset class or that classification, more so than categorizing it as that and always keeping it at that. And so I think the biggest flaw in TDR is that there hasn't been a lot of movement out, and so we don't really pay attention to it anymore.
This is Louis. I'll just chime in and say, I usually like to draw the distinction between something that was initiated by the bank to help the troubled borrowers, or it was something that was imposed by an external force, for instance, COVID, or during the subprime crisis, there may have been certain regulatory or political pressure to modify some of the loans to help out. There wasn't a voluntary decision by the bank. And so understanding special external forces that cause loan modifications and separating that out from something that a bank would do in the normal operations to help its borrowers, I think that's something that I look out for. And I might model those two categories separately, but typically, that's what I pay attention to.
Great, thank you. And we are really close to the end of our time here today. So I really appreciate all of the effort that's gone into today, and certainly want to open it up and see if there's any very quick final closing comments from any of our roundtable participants today. All right. And with that, before I kind of hand it over to Rich again, just really want to thank you for your engagement and really your willingness to share with us today. It's greatly appreciated, and it's absolutely critical to our process. From a staff perspective, we are planning to really just digest all of the feedback that we heard today and come back to the board in the near future to discuss whether the board wants to add a project or projects to the technical agenda based on what we heard. In addition, we are going to continue to keep you up to date on our PIR activities and the outreach that we complete as we go through our PIR process. Additionally, I do want to really thank the staff for all of the hard work that went into putting together this roundtable. definitely a significant undertaking, and I really thought that they did a great job. And also, I would like to especially thank Amin Mohammed, who has been an instrumental and really valued member of the Cecil team. Amin is going to be moving on to new and exciting challenges. So while we are going to miss working with him every day, we are hoping to see him maybe on the other side of a roundtable someday. So with that, I'll turn it over to Rich.
Great, thanks, Hillary, and an impressive job running through this today. So I think it went very well. And everybody, thank you for spending your morning with us. One thing I do want to emphasize, though, this isn't a one and done. In other words, it's not this was your opportunity to provide us input. And if you didn't get it to make a comment, or if there's other developments that you see in the future, we're open for business. So please continue to share your feedback with us. We'll come find you, but it's also okay just to reach out to us. So once again, thanks very much. Appreciate it, and enjoy the rest of the day.
Thank you so much, everyone.